Why is it that Kenya at 70%, we are saying we're in jitters, we're saying we're in the red zone? Why is that?
The relationship between economic growth and debt is positive only up until a certain point, beyond which it turns negative.
What is the role of the IMF in the uptake of debt?
The extent at which taxation is relevant is how robust your tax base is vis-a-vis your debt, because taxation goes into your debt carrying capacity.
Borrowing is towards development, but we're not seeing development expenditure sort of matching the kind of monies that they get.
Welcome to our third of 4 debates on Kenya's Eurobond debt debate, weighing Kenya's financial future. Today, we will be speaking on a couple of things that we have also begun kind of talking about, but as we further into this discussion, we evaluate Kenya's economic strategy in terms of the Eurobond and whether that strategy is working or not. In this debate, I'll be joined by Cuba Houghton, who is an economic researcher with expertise in public finance from the International Budget Partnership Kenya, as well as Churchill Ogutu, who is an economist with IC Asset Managers. Previously, Churchill was a head of research at Gaze Capital, also held positions at Chase Assurance Agency and Britam Holdings. Joining us are students from KCA University, NIBS College, as well as ZTech University and KEMO. Karibuni sana, let's debate. So this conversation on Kenya's Eurobond, Cuba, is an interesting conversation. What do you think about it before we get into the questions of the day?
I think one of the reasons why the Eurobond debate has really come up recently, of course, is because the Eurobond is due this year in June, right? The first Eurobond that we took in 2014. And it raises a big question on value for money for decisions made by government, right? So, of course, there's the special report, audit report by the Office of the Auditor General, where there was an investigation into the proceeds of the Eurobond, and it was found that the value for money could not be confirmed for $2 billion, about 340 something billion in today's terms, Kenyan shillings in today's terms. So I think the conversation is really important from an accountability perspective, right? So Kenya, yes, we're taking up loans in order to finance expenditure in these different sectors and our public services. But is there value for money in terms of the economic growth that we're seeing, the services that we all deserve as citizens because of the right in our constitution? So I think that's the reason why the Eurobond conversation and the debate we're having today has stuck, because it's a conversation around, is there value for money? Are we making the right decisions on how we need to borrow? Because the truth is we need to borrow as a country, but are we making the right decisions on how we go about that? I think that's one of the reasons why it's quite important.
Churchill, it's a timely conversation, but is it a necessary conversation?
Yeah, definitely. And I think we're speaking to the converted, as a large majority of our audience here are Kenyans. And public debt tends to be one of the most dominant, if not pertinent issue. Most of the people have an opinion around public debt. And so if I may take you back to 3 years ago, when we entered into the current IMF program, that's also another part of our debt that we had. And there was this trending topic by Kenyans, how IMF should stop lending loans to Kenya. But just basically touching on the points that Cuba has raised about the efficiency of the loans that we carry on, that we take as a government, and which ideally as taxpayers we now come years down the line to come and service. Things to do with debt, and this is where the context that Eurobond is coming in, tends to have some dominant, tends to be dominant in most of the public discourse. And obviously, to the point of Eurobond, this was $2 billion that was coming due in the next couple of months. And evidently, if you look across a number of emerging countries and frontier markets, this $2 billion maturity was the single largest maturity. So obviously there were some concerns. Will Kenya be able to pretty much sort it out? So that pretty much now ties into your question that how will Kenya be able to resolve this issue that there is a maturity coming due, it's the single largest maturity, will they be able to do it? So that is the context of your question, Ian.
So Cuba, what are the primary drivers behind Kenya's reliance on debt as a financing strategy, and how do they impact the country's economic trajectory?
Thank you. I think before I answer that, I think there's an important aspect of why this Eurobond debate is so important that perhaps we didn't mention, is that all of us in this room pay tax in one form or another. And the reason why we talk about public debt so much today as compared to 2021 or 2020 is that the national government has decided that one of the ways it's going to service this debt, right, the Eurobond, is through taxing us or through getting more tax revenue, which, as you saw, as a result of the Finance Bill or Finance Act of 2023, involved raising a lot of taxes, right? And that combined with a number of other factors like the war in Russia and Ukraine and the decisions around interest rates that the US Federal Reserve has been making has contributed to this rise in the cost of living. So I think that's why a lot of Kenyans and even players in the region have come alive to this conversation around Eurobond. But on your question on the reason why we have relied on debt over time, I think it stems back to the decisions that we made on what we want to achieve in 2007, right? That's when we had the Vision 2030. And that basically set the development blueprint for Kenya in terms of the services that we want to see, the kind of progress that we want to see, for example, in healthcare and education. And there's this conversation around, kind of a just, inclusive growth for Kenya. And so your decisions on your development philosophy, right? So how you wish to go about development have an implication on how you choose to go about financing that development, right? Because public debt is just one of perhaps 4 or 5 options that the national government has in order to service these services or to deliver these services. But what we find over time is that, for good or for worse, there was quite an emphasis on infrastructure, right? So the building of roads, the building of, there's heavy in transport infrastructure, but also building of other infrastructure like, hospitals and schools, among other things. But there was quite a heavy emphasis on that over time, right? We've seen that a lot of these loans that have been taken up have actually been to finance some kind of infrastructure development. And the challenge with taking on infrastructure development in a short period of time or over a period of time is that you need finance, a large amount of finance in a short period of time, right? And one of the ways that you can get that is through loans, right? And of course, tax revenue, yes, you collect it daily, but it's normally not sufficient to finance what we want to spend each year. So I think that's part of how we've come to rely on debt. Of course, it doesn't say that that has to be the case going forward, right? Kenya could make a lot of innovative or more radical decisions on how we want to go about development. So do we want to develop more, or do we want to spend more on human capital? Do we want to spend more on health, right? Because in all of our personal lives, every day or every time you do get a bit of money, you have a decision on what you spend it on, right? Maybe you have a vision of where you want to be in 10 years. So what can you spend on today that will see you actually achieve that, right? So are you spending it on your health insurance? Are you spending it on your children's education or your personal education or personal development? Are you spending it on rent, for example? So I think the reliance on public debt or the reliance on borrowing over time has emerged from the development decisions that we've made, particularly this kind of brick and mortar type approach to development. And we do see that has had an implication on the accumulation of debt over time. So it stems back to the Vision 2030 and the decisions that we made around how we want to develop and how that's played out over time.
Churchill, same question. Bear in mind that the Treasury is signaling that we have to wait until 2026 before we start witnessing any improvement in debt sustainability in terms of any indicators to that. And what exactly are we doing really in terms of ensuring that we do change the reliance on debt?
Thanks, Jugona. I mean, debt has been part and parcel of Kenya's financing strategy ever since we had our independence, ever since we became a republic. That's pretty much 60 years back. And just come to think about it, Kenya has gotten its independence, and you can imagine the kind of income levels the colonizers have gone, and then the kind of income levels that now has been left to the indigenous Kenyans to kickstart their economic growth was quite low at that point. So we find that the level of tax that they were able to generate from Kenyans at that point in time was quite low to be able to develop, get into some of these development needs. We need to build roads, we need to get hospitals, we need to pretty much all these development expenditure needs. So ever since we became a republic, you find that we've been relying on some form of debt to be able to sort of kickstart the economic growth. Cuba made reference to Vision 2030, but ever since 1964, we've been having development plans, 5 years, 4 years, timeframes. So that has been part of the game plan from an economic planning perspective. So from that perspective, we find that the kind of debt that we used to get back then was basically foreign financing, the donor financing, development financing, kind of the World Banks, the IMF, coming into play to be able to finance the development needs. And you can see from a perspective of supply side, the government tends to be the largest spender in an economy. So as it spends in the economy, it sort of boosts the economic prospects of that particular country. So you find that there are also public goods that are required by the government so that the government cannot be able to deliver. Building of roads, you don't expect that as a company you go on and starting building roads. It's now the role of the government to come in and build all the roads or the infrastructural development. So that is where debt has come in, and it's not peculiar to Kenya, it's across the globe. So over the years, you can point some of the development projects that have been undertaken by the government in terms of by debt, roads, even if you go to Eastlands area of Nairobi, some of those projects, the housing projects in Eastlands were basically financed by debt at that point in time. So come over the years up until 2007, Vision 2030, and the goal was that the the GDP growth should be 10% from 2008 all the way to 2030. So how do we fine-tune the economy so that you cannot be able to deliver 10% growth rate? Obviously, in hindsight, we've missed that target by a mile. And I'm actually saying that because today, the government is actually launching the 4th medium-term plan. So this Vision 2030 is being implemented in 5-year phases, 2008 to 2013. That was the first medium-term plan in the context of Vision 2030. 2013 to 2017 was the second medium-term plan. The third medium-term plan, which colloquially we refer to as the Big Four, from 2017 to 2022. So what is being launched today is from 2023 to 2027. Obviously, it's been launched with some lag, with some significant lag, because now we're in 2024. But nonetheless, the government is trying to articulate what are the development needs, what are the economic growth opportunities and the prospects that they would like Kenya to be, obviously over a 5-year time frame. But if you step back and look at Vision 2030, with a 10% growth rate, how will they be able to engineer such? They may not be able to get the necessary revenue to sort of have organic financing needs, and hence the need of getting into debt financing. Obviously, over the years, there's been some switch in how Kenya has been financing from a debt perspective. Initially, it used to be external financing, concessional rates from the World Bank by the IMF, but gradually we've gotten into commercial financing, first domestic, and reopening of domestic financing source. Think about it, the government wants also to ensure that there's increased savings amongst its populace. And that's also one of the goals that even the current regime has been quite pertinent, just to increase the savings rate locally. But how do you go about it? You need to mobilize all the monies from the domestic people. So that's where treasury bills are issued on a weekly basis. On a monthly basis, we have treasury bonds. So that came in around 1980s. But now there's an opportunity. We can't keep the low concessional financing from an external side. So with the rebasing that happened in 2013, if probably you remember, Kenya became a middle income country. So that meant that we will not keep on relying on the low concessional financing. So that's where also we sort of pivoted into commercial borrowing, and hence the Eurobond financing that has come in. So we find that there's been a skew, a balance between domestic borrowing, also external borrowing. So I think I may take a pause at this point. I've had the bell ringing.
All right, your time is up, really.
Yeah.
But you bring up some very good points, and this drives to a question I had asked you earlier in terms of how we have pegged our debt. We've moved away from pegging it, we've moved away from the old ways. We have now pegged it on GDP. And there are other alternative ways. Some members of parliament were suggesting we peg our debt on revenue collection. Is this even feasible, Cuba?
It's a question that I'm conflicted about. So from an economist perspective or an economics perspective, I see the value of pegging your debt to GDP, because your GDP is a measure of your size of your economy, right? So that's an indication of how much tax you might collect, right? But I don't think that resonates with citizens, right? If you're to ask the average Kenyan whether they can define in terms what GDP is, right? Or what GDP means to them, it doesn't really matter, right? What citizens do want to see is services, right? So what the debt actually enables. So one of the things we've been looking at the International Budget Partnership Kenya is a way to kind of define this debt sustainability conversation a bit differently. Another issue with using the percentage of GDP as your anchor is that it may not actually solve the problem of having a sustainable debt, because the GDP is, it's a moving target, right? So you can always say that your GDP has grown more than it has, or it's higher than it probably is, and that would make your debt look sustainable. So one of the things we're looking at is there a way to factor in the cost of debt to service delivery? And I can give you an example. So in the current financial year, if you look at the budget, which is the financial year 2023-2024, the budget documents are available on the National Treasury website. The amount that we've allocated to spend on debt is about 1.8 trillion at this point, if you consider the supplementary budget as well. But the revenue we expect to collect is about 2.57 trillion or so, right? So, out of every 100 shillings that we collect in revenue, we're going to spend 73 or so on debt. And the problem with that is that it leaves 27 shillings for spending on health, spending on education, and other services, which then, of course, prompts more borrowing. But that creates a new phenomena when it comes to debt, a new cost of debt. So it's almost like an externality of borrowing, which is that now you have less money available to spend on your services, right? So you could call it now crowding out of public expenditure. So typically we talk about crowding out of private sector, but there's that crowding out of public expenditure. So is there a way to think about debt sustainability from an aspect of what is actually the cost of debt when we talk about the repayments and the redemptions that we have to do for service delivery, right? It's a bit circular because, of course, you're borrowing to deliver services, but there's an aspect in which when you only have 27 out of 100 shillings to spend on your services, right? And you're spending the majority on debt, then is there a way that you can kind of now look at that as the true cost of debt, right? And so previously we did have a debt limit, right, which was just a number beyond which we shouldn't go. which didn't last long, which is hence why we moved to a debt anchor, because it's a moving target. But I do believe that there's a certain way that we can try and reframe debt sustainability from a service delivery perspective, because that's what I would say matters to citizens. Yeah, so perhaps it's a area of ongoing debate, I would say.
Cuba says he's conflicted. Are you also conflicted on the same?
To a certain degree, but if you come to think about it, so why do we go through the public debt to GDP ratio route? So it's somewhat a simplistic way of looking at how we are able to service our debt. Because over the years, you find that right now the public debt is around 11 trillion as of December. But now the GDP, you're comparing it within a certain year, the current within the last 12 months, so from January all the way to December. So that GDP component, but then you're comparing to the stock of public debt which you've accumulated ever since you got independence. So it does not mean that that level of income or your GDP, if you sort of translate it as income, you will, at any given point, you'll now be able to pay off this debt. So, but it's just some sort of guardrails as to how our public debt has been accumulating over the years. But why did we have to switch? Because I remember this switch actually came in 2019, thereabout, whereby initially we used to have the public debt to GDP at 50%. That was what it was pegged before the amendments that came in 2019. So 50%, the threshold in terms of public debt to GDP ratio. Obviously, we'd surpassed it, but now the argument that the parliamentarians put at that point is that they cannot relate public debt to GDP. Anyone on the street can now be able to sort of put what is this public debt to GDP ratio, what does it even mean in the first place? So that now sort of brought in the rationale that we now need to have a ceiling, that the level of debt that we can now be able to have at any given point is, initially it was 9 trillion, but then they hiked it up to 11 trillion. So those are some of the ceilings that they put in. But you need to also have, if you have a debt ceiling, you also now come to the fiscal. It will have worked well if at any given point, either we reduce our level of borrowing so that we don't keep on accumulating this stock of public debts, or in a more ideal situation, we run what we call a budget, a balanced budget, whereby the levels of revenue you can get, this is on the tax revenue or even what we call the appropriation in aid revenue, pretty much matches what you are spending in any given fiscal year. So at that case, you are running a budget balance, a balanced budget. So as now to be able to retain public debt, at that point it was around 7 trillion static at that level. But I mean, we are quite optimistic at that point, and that is what has come, that the outturn in the last 3 fiscal years has proved us right. People who actually put an opinion piece that we will go to the route, if you, some of us who keep following what's happening in the US, there's usually sporadic debt ceiling debates. There's some sequestration. So basically, the houses in the US, both the Senate and also the House of Republics, they're not able to agree on how to be able to extend this ceiling. So this was bound to happen. So now the pivot now came within the context of an IMF program that probably a ceiling doesn't make sense. We need to sort of go back to where all the other countries are, because countries, in terms of apple-to-apple comparison, they look at it in those kind of public to debt GDP. So that is where we reverted back to the public debt to GDP. Right now, we are looking at it in terms of 55%. That is the metric that we've been given. But now, in technically net present value terms. So what that means is that even if our stock of public debt is at 11 trillion, there's some components which is grants we are given by the development partners or donor financing, but actually will not be able to pay interest on, or will not even be able to return it. So basically, that's the 55%. But we need to ensure that since this amendment was done in October last year, we have a time frame of 5 years to be able to hit that 55%. Right now, we're looking at 63%. Obviously, with the exchange rate movement that has happened in the last 6 weeks, the stock of public debt, remember that it's both external and domestic. So the external component will come lower because of, if you look at it at December, we are converting the external debt at around 155 on the dollar, but right now, dollar Kenya shilling rate has come to 135. So obviously it will reduce it, but probably will hit it by before the October 2028 deadline, the PFM Act.
All right, there are pieces of paper that are passing around. Keep writing your questions, keep sending them back to the IR so that we can evaluate the questions and also ask the panelists as well. We'll come to your questions in just a moment, but Cuba, he has talked about examples of the US in terms of their debt to GDP ratio and all that. We have countries like Japan who's almost double the percentage to 200%. Why is it that Kenya at 70%, we are saying we're in jitters, we're saying we're in the red zone? Why is that?
So of course, the problem with comparing debt numbers is, of course, you're dealing with different countries and different economies, right? So there's an apples to oranges conversation where, Japan is, the GDP per capita in Japan is probably several times what it is in Kenya. But I think in terms of the borrowing decisions that Japan has made, one of the things that you do notice about Japan's debt, and it's not something that we've studied externally, but extensively, is that a lot of it is owned to institutions within Japan, right? So the central bank, the social security funds. So that's a big proportion of their debt, and it's primarily low interest debt. You can take another example that I found recently, actually, from, I think it's Cambodia, who happen to have, their debt is 99% external, right? 98, 99% external, which of course you'd think exposes them to foreign exchange risk, right? So if what happened last year to the Kenyan shilling happens to the Cambodian currency, then you'd expect their debt to increase quite significantly. But what has happened is that, of course, they have access to more concessional finance. So it's hard to compare countries, but I do believe that one of the reasons it's also concerning in Kenya's case, even though it's just 70% of GDP, is because there are other aspects that determine, like we've been speaking about, whether debt is sustainable. So for example, you could calculate Kenya's debt to revenue ratio, right? That's both public and external and domestic. And you find that, like we said, almost 73% of our revenue is being spent or will be spent in this financial year on debt servicing. But if you look at Japan, it takes about 50%, right? So it has to do with both the structure and size of the economy, but also the types of borrowing decisions that have been made. Of course, Japan it is a bit risky, of course, because the government borrows to then invest in high return and risky assets. But I think there's both kind of the natural projections or trajectory of economies and how that's arised, but also the different borrowing decisions that have been made in different jurisdictions, including more radical ones like Ethiopia or Ghana, where the country basically says that it's unable to meet its debt obligations. But that's probably a conversation we can have later on.
Are we on the same trajectory as well?
Obviously, there are a bit of some nuances that you need to put in place when you're comparing Kenya at 70% vis-a-vis Japan at 250%. So you find that our stock of debt is pretty much domestic and also external. So it's a 50-50% split in Kenya. But you find that in Japan, they're pretty much borrowing in Japanese yen. So that's in their local currency. Also the fact that because of some structural issues in Japan, you find that between 1990 to 2000, it's like they really completely messed the economy. They really didn't have that growth in their economies. So what happened since 2000 all the way right now is that the government has been trying to boost demand in the economy. So one way they have been doing that is basically the Bank of Japan has been sort of coming into the market and buying the bonds so as to free banks, so as to free finances, or so as to give the opportunity for banks to be able to finance companies and also households. So they have been doing that. It's only that up until last week, even after the global financial crisis that happened, they even went into a negative interest rate regime. It was only that last week that they sort of put an intention that they want to move away from the negative interest rate regime so that they can now be able to come back to orthodoxy in terms of how they are doing things because they've seen there's that rebound in economic demand pressures in the economy, so those kind of things. And also their interest rates, because they were within a negative interest rate regime, you can imagine their cost of borrowing was quite low, even lower than 1% vis-a-vis the average cost of debt. If you look at the T-bills for Kenyan context, just to give you some flavor, you find that right now we're at 16% in Kenya shillings, Eurobond, and also the commercial borrowing you've been getting. You can look at it, the kind of cost of financing is higher vis-a-vis cost of financing in Japanese case. So those are some of the nuances that come. So rather than looking at it from 250% GDP in Japan and 70% and probably need to get to 250%, we will not be able to, at 250% debt to GDP, and at an interest cost above 10%, we'll be really strangling ourselves or borrowing from the future. Exactly, yeah.
So that sets us squarely to our main question then. Is relying on debt a sustainable economic growth strategy?
So the relationship between debt and economic growth in the literature, right, or studies that have been done on the topic is, I wouldn't say inconclusive, but it's there's no agreement on the actual impact, right? And it also depends on the frame of thinking or the school of economic thought that you take. So there was a recent study done that in 2023 that looked at basically a review of studies or a study of studies, and basically looked at all of the literature on public debt and economic growth. And it found that there are basically three camps, right? One camp that says there's a negative effect or the relationship is negative between public debt and economic growth. Another camp which believes that there is no relationship between public debt and economic growth. That's, I think, the monetary school of thought and monetary theorists. And then the final one is that there is a positive impact, but only up until a certain point. So, for example, there's a study done on 30 sub-Saharan African countries, I think over 30 or so years, that found that over the long term, the impact has been negative, right? Or the relationship between economic growth and debt is negative. And I guess also before we hop into that, of course, the theoretical relationship between debt and economic growth is that debt allows investment in certain things that can create income. So you take the example of the Nairobi Thika Highway, right? And how before that, there was no TRM, there was no Garden City, there was no Quiver, I think that's what it's called, Quiver, right? And all the other liquor stores along that road. But now there is, right? With the road, came development, people moved into homes there, people got jobs there, right? So they're able to now contribute to the economy and participate in the economy, and also, importantly, pay taxes. So that's how debt relates to the economy. Of course, that was a loan. I forget who it's from, but it was a loan taken back in those days. So that's the theoretical relationship. But in practice, what we do find, another study showed that the relationship between economic growth and debt is positive only up until a certain point, beyond which it turns negative. And that's what you'd call the debt sustainability threshold, right? So in a number of countries, it was found, I think in emerging markets, it was about 50% of GDP. If it goes beyond 50%, then it becomes a bit of an issue. And so it's inconclusive, but it's still ambiguous onto this exact effect. But I think the lesson from that is that it's not to stop borrowing. The lesson for a country like Kenya is not to stop borrowing, but it's actually to make better borrowing decisions such that what you do borrow does actually contribute for sure to economic growth, right? And these investments in profitable, quote unquote, or investments that you can see the value for money, right? In infrastructure, if it's in social sectors, if it's in these different things. So I think it does depend heavily on whether whatever you borrow is actually impacting the economy. And economy here, we both mean in terms of the actual value that it brings, so the jobs that it creates, et cetera, and also the service delivery, but also in terms of across the economy, right? So one of these studies that we're doing at the International Budget Partnership is around the distribution of debt-financed capital projects. right? Because and the theory is that if everyone is paying tax, right? We all pay tax here if we purchase goods that have VAT on them, for example. We should all be benefiting from the debt that the taxes are used to pay, right? So if we should all be benefiting from it, it means that we should have an equitable distribution of these debt finance projects. So one of the things that we are looking into is whether there's actually a distribution of that debt finance development, because that then determines whether not only is your debt actually being realizing value for money, but realizing value for money or growing the economy across the board, right? So I think those are some of the lessons that we see from the complex relationship between public debt and economic growth. I mean, of course, you can bring in the conversation around interest rate, the forex, and how debt impacts that, or how when Kenya's currency, or the shilling, depreciated very heavily, we saw a big growth in debt, right? Which means that more of our revenue will have to, or in this case, your GDP, or the tax you're getting from your GDP, is going towards paying debt. So it's a very complex relationship that I don't think the literature is very settled on. But yeah, the lesson is that the impact is more likely to be positive if the investments made from loans are actually efficacious and able to actually realize growth and service delivery.
Same question. He talks about us using our debt to ensure that we actually equate it to growth. And that has been our big problem. In our other two debates we had, that's where the fight is. But really the question is relying on debt a sustainable economic growth strategy?
Let me just give a biased answer because within the capital markets industry, so as you heard from the introduction, I'm an economist within an asset management firm. So my bread and butter is what you call fixed income. Why am I bringing this point? So you find that even some of the countries coming to issue debt, in a way, there's a whole ecosystem which also builds to economic growth. You find that one of the goals that the government will want to increase or have a savings culture. So how do you do that? You have the NSSF, you have the pensions, but you find that as they aggregate capital from all the people, but they need also to deploy into some investments. So some of the investments that they get in, they can go to the Nairobi Securities Exchange, they can put monies also into other assets, we call them assets. But because you're investing for pensioners, you find that their safe assets are now fixed income. This is now the treasury bills and treasury bonds. And that's pretty much contrary to the public debt. On a weekly basis, there's a treasury bill. On a monthly basis, the government issues treasury bonds. And you find that there's this whole ecosystem within the capital markets that is hinging on public debt. So you find that banks also come in to deploy their monies to get some returns from within the fixed income assets, treasury bills or treasury bonds, and also even euro bonds. But so the question now becomes from a sustainability perspective is, yes, people give money, or pension funds, investors, they give money to the government in the context of public debt. But what kind of expenditure is accrued or is done by the government so as to be able to ensure a sustainability? Because at the end of the day, government needs to pay the investors the money that they are already promised to pay them. So that now comes to viability of the public expenditure that is done. And if you look at the budget documents, they talk about a minimum rate of investment of 10%. So whatever project that the government gets itself in, it has to get like a 10% return. So let's pick the elephant in the room over here, that's SGR. Project. It costed us something $3 billion thereabout. So if you work it in current exchange rate, you're looking at something in the order of 450 billion. At least that was the preliminary phase of the SGR project, but over time it has grown. So that means that at any given year, the government needs to, if it invested 450 billion, it has to get 10%, so 45 billion in terms of revenue so as to be able to justify why it entered into this particular, why it got into this particular project. So in terms of that perspective, the sustainability, that's where there are some question marks, which Cuba has alluded to. But we can also now flip it up that there's a big ecosystem within the capital markets, which also are drivers of the economic growth. It may not be like for like that people within the capital markets, if you need some financing, you cannot be able to approach your bank, or you can even go to some corporate finance houses so that they cannot be able to have discussion with you. As one person who is needing capital, you can be matched with people who have the capital. So that also comes into sort of ensure that there's economic growth in the economy. But in terms of how the money is deployed, that's where the question marks is. And just to give an example, the government of Kenya issues what is called an infrastructure bond. So basically, infrastructure bond, they sort of issue it every 2 or 3 months in any given financial year. Initially, they had pegged that whatever they get from the infrastructural bond is now channeled towards roads, water, and energy sector. But if you look at the budget development needs, you can't be able to relate it. And as an example, last month they were looking at 70 billion to be floated from an infrastructure bond. They received a massive 280 billion. They accepted 240 billion, but because there was a bond that was maturing that particular month, 70 billion, so they sort of knocked it off. So the net amount they received was 170 billion. So you can imagine, because they had issued an infrastructure bond, ideally they should have now invested this 170 billion into infrastructural projects. We saw the numbers that came in Kenya Gazette last week on Friday. Just a sense of the development expenditure. I mean, we can't really relate that. So those are some of the issues that people who are critiquing the government spending needs, they're just raising questions. Borrowing is towards development, but we're not seeing development expenditure sort of matching the kind of monies that they get, which they are earmarking for development. So that brings issues such as greenwashing. You're sort of borrowing monies that you want to do something, but you're not ending up doing, you're not channeling to the right sources. So those are some of the issues that come to impede the economic growth in a country.
We'll come back to discuss an issue that you want to jump in. All right.
I do agree with what Churchill has said around the need for accountability in how development finance is being spent, or loan finance is being spent. I would like to push back on the idea that, government playing this role in the capital markets by accepting bids from private investors is solely good, because of course you have, and I'm sure we're familiar with the crowding out effect of private sector, right? Which is that the more the government borrows from the private sector, the higher, for example, from banks, the higher the interest rate that banks offer, because if interest rates to us, right? So for loans that we get from the banks, because you can't compete with government, right? So they're going to offer a lot higher interest rates, which means that the rest of the economy, apart from the banks and perhaps the social security funds that hold the most of our domestic bonds, are not able to actually perhaps undertake investment or take loans themselves that they would be able to use to actually grow the economy and grow the size of their businesses. So I think that's also another question around how we choose to raise debt, because most of us, I also came to know that, because I wasn't I hadn't graduated by then, but in 2014, one of the reasons why we chose to take up a Eurobond, apart from the fact that the market was perhaps ripe for it, was that we had a domestic debt problem, right? Which is the situation we've talked about now, where the government borrowing more and issuing more bills and bonds and accepting bids drove up the interest rate, right? Which is having a negative impact on the rest of the economy. So that's why one of the driving factors for the Eurobond. So I do think the conversation around domestic debt is a bit more nuanced. And so, it's a bit of a gray area, because like Churchill mentioned, it becomes very difficult to connect an issuance, or the accepting of bids by the central bank to actual expenditure projects. You mentioned it's an infrastructure bond, so you should ideally go to infrastructure, right? So that's a transparency issue that's really not clear. So I think, and it speaks to the issue of government involvement in the economy, right? I think it's a lot more nuanced than just lending to the private sector.
All right, we'll come back and discuss in terms of, is there a risk, because the government has pegged, in terms of our borrowing, it has pegged it on GDP. Is there a risk of tampering with GDP? We'll come back to that, but first, let's get questions from the audience here. Shanzu from ZTech. Shanzu, where are you? Let's get a mic to her. Where are you?
The IMF has increased the limit of the government borrowing. That means from 435% of quota to 600% of quota. That led to the government borrowing up to 385 billions. So what is the role of the IMF in the uptake of debt? And do you think the IMF is doing a disservice to our economy?
All right.
Thank you.
Houghton, you take that, the role of IMF, and is it doing a disservice to our economy? There's also a question from Karaoke Rongo from NIBS. Karaoke, where are you?
Good morning, everyone. I am Karaoke Rungu from NIBS College, and I have a question concerning the risk. I just had the moderator asking, but my question is, what are the potential risks that we as country will face when we rely on Eurobonds or debt that we acquire from external bodies? Thank you.
All right. Where are you, James?
James from ZTech. I have two questions with me here. The first one, what strategy does Kenya employ to ensure debt sustainability and avoid overburdening future generation? And the next one is, what mechanisms are in place to hold policymakers accountable for the debt-related decisions? Thank you.
All right. Leshan?
I have a question. How do our government balance the short term, having to maintain the fiscal policy to ensure sustainability of debt? Thank you.
All right. So Churchill, you will take on that question in terms of holding policymakers accountable. There was a question on strategy of managing debt. That will go to Houghton as well. Let's begin with the question in terms of the role of IMF. Is it more beneficial to us, or is it harming us the more? Houghton.
It's a great question. Of course, these international financial institutions, or IFIs, like the IMF, they've been around for a while, and their role over time has kind of evolved from, or has centered around providing sources of finance, right, and support for developing countries among other nations. But what you do find, let's bring it back to Kenya at the moment, is that that finance tends to come with strings attached, right? So like in the case of the recent money we got from IMF, there's certain reforms that are pegged on us getting that money, right? There are several cases where IMF has stepped in to support economies that are struggling with their debt, right? So Sri Lanka, among others, but has actually, when the time comes for actually giving the money, has said that you've not met this set of reforms, so you cannot access this finance as of now. So it's important to know that as much as the debt is concessional, right, it has relatively low interest rates, or it's on favorable terms, there are different reforms that you do see as a result of that. So there's a question, a bit of fiscal independence there. And again, if you want to find out what these kind of conditions are, the IMF, when they do their reviews, they do have a document where they talk about the different reforms that the Treasury has committed to or is looking into. So for example, from the 6th review that we saw recently, we know there's going to be a supplementary budget this month, which is meant to be a part of this fiscal consolidation effort, right? And what fiscal consolidation is basically attempting to reduce your expenditure while increasing your tax revenue. And of course, your deficit, which is the difference between your expenditure and your tax revenue, is what you borrow. So the idea is that if you consolidate fiscally or you consolidate your fiscal balance, you're able to reduce the amount that you borrow over the long term. But of course, there are caveats to that, which is the questions arise on what expenditure do you reduce, right? So if I was to ask you, whether you think government spending is unsustainable or fair, many of you may say no. But then the question comes, where would you cut the budget, right? Would you cut the salaries of nurses? Would you cut, and of course there's the national government and county government. So we're talking about two kind of types of budgets or levels of budget. So the question around whether the role of these international financial institutions, of course, depends upon not only the finance that we get for them and the kind of things that they finance, and IMF is an example, and it tends to give us budgetary support, but it's also what are the things that we have to adhere to as a result of getting that money, right? Because, as they say, no money is free. If you compare to someone like the World Bank, who tends to, which tends to finance specific projects, so from an accountability perspective, you're actually able to see we borrowed this much in 2021 from the World Bank, and this is where it is, right? So the World Bank has a very good website that shows the different projects, like the affordable housing program that Churchill mentioned. I'm sure if my senior was here, he would mention how the recent money we got from IMF stopped us from getting into a default, which is essentially the moment where you say, I'm unable to pay, right? But that's also caveated, or there's a caveat there, which is that we've also been receiving a lot of money from other IFIs, right? The African Development Bank, and among others. So destroying our economy, perhaps it's not clear whether that's the case. There is a history behind that, and you can read about the structural adjustment programs of the 90s. But it's, there's a transparency aspect to that.
Okay, when you talk about the question on strategy of, you come back to you on the question on strategy of managing debt, but first, balancing the policymakers, the accountability. What can we do to ensure that the policymakers, parliamentarians are able to actually keep the government accountable on this debt?
So in terms of accountability right now, I think there's some laser focus on the executive in terms of you are the ones who've driven us to the high debt levels that we've had. We had it even during the campaign periods amongst both political protagonists. But I think there are a number of state actors that needs to be accounted. The executive, this is National Treasury, are the ones who are the policy makers. They come up with even in the context of budgets, they come up with this is our revenue that we'll be able to get, this is the expenditure, and this is the borrowing that we'll be able to get that will need to finance the budget, because our revenue is falling short of the expenditure. And they don't act in a vacuum. They go to parliamentarians. There's a whole system. There's a finance committee. There's a public debt and privatization committee, which sort of scrutinize the budget and also the financing. So you find that there are various players that needs to be accountable, even to the current state that we are in. Our debt at 11 trillion, 70% of GDP. So the number of accountability that needs to be done. It's only that legislature, they sort of have an oversight role, but I think it might be not fair to say that they have not played their part in Kenya being where it is right now. Obviously, they've been the ones who have been approving the budgets. They will have had numerous opportunities of reducing the spending so that you can see a lower reliance of debt, but they have not been able to do that. So I think first and foremost, we also need to find a way that even we can now be able to hold account our members of parliament, so in terms of matters to do with debt. There's a question that also Shanzu addressed. Let me just put some context to it in terms of IMF raising limits. So think of IMF as how to think of a normal circle. You have your shares in a circle, and based on your shares in the circle, you have some limits that you can now be able to get in terms of borrowing. So that similar principle somewhat works with IMF. There are 190 countries who are part of the IMF member countries. So they have different quotas. So even Kenya has its own quota. So what actually was being put out was the increase in limits actually came last year. Previously, it was based on your quota, you could now be able to borrow 1.35 times, so pretty much 135% in any given year. So find that how the IMF works, if you go to a bank or if you go to a circle, if you're borrowing, say, 1 million, they give you 1 million upfront. This is what the money that you want to borrow. But now with IMF, they will not give you that 1 million, they'll give you 100,000. Do some reforms after 6 months, you get another 100,000 like that. So the disbursements is within a period of time. So you find that in the current program, which started in April 2021, there's been some, what you call some augmentation. So it's come to around $3.85 billion if you convert it in dollars, though the currency that IMF use is special drawing rights, but in terms of our thinking, we convert it to dollars and also to Kenya shillings. So from that perspective, in any given year, our quota in terms of SDR is 542 million. So just think about it. This is our quota, which is around 0.11% of the IMF financing to all the countries. So out of this 542 million, so it's like the rail guard is that in any given year, you can get up to 1.35% of that quota that you have been given. And then cumulatively, so basically means that because we are in a program that started in 2021, we have had some financing from IMF over the years. And then as you take an IMF program, your repayment period, unlike borrowing from a bank, tends to be a bit longer, 10 years, 20 years, 30 years. So find that right now also there are some monies that we had borrowed from previous IMF programs that we're still repaying. So even that, they accumulate it, and also the monies that you get in any given year. So up until March last year, in any given year, you'd get 135%, that is the limit, and the cumulative, what you have current program and also the previous programs, 3 times, so 435%. So these limits were increased to 200% in any given year. So if the quota is, say, $1 billion, so Kenya can now be able to get disbursements 2 times of that, so $2 billion. So that's pretty much what was it. So the thinking was that because of COVID came in, a number of countries had had issues, balance of payments. So that is the thinking from the IMF fund, just to increase the limits. But it does not say that if your limit at a bank is 10 million, that you can just walk to a bank and get 10 million. It basically, they'll have to scrutinize you, the reforms that you do. So you might not even get, the limits might be 10 million, but based on your capacity at any given point, probably you can get 2 million. So as it is right now, Shanzu, yes, the limit has been increased, but doesn't mean that we are either in distress or we are in cahoots with IMF, or IMF are now running over. It's just basically from a fund IMF perspective, all the countries, the limits to all countries had it been increased, yeah.
All right, so the question on strategy of managing debt, kindly combine it with the potential risks of relying on debt so that we tackle the 2 of them.
Okay, allow me to tackle 3, because I do believe that the mechanism mentioned by Churchill in terms of who do we hold accountable for our public debt, right? So there's a lot of public debt operations that happen at National Treasury, the Public Debt Management Offices, which is a unit within National Treasury, so at the executive level. But I'd like to emphasize the role of Parliament, right, and your members of Parliament as the oversight institution over how much we borrow and how that's managed, right? So, for example, every year, alongside the budget policy statement, which is a budget document that's released in around February, late February, which details the direction of government over the next year, right? And this is specifically with reference to the budget. So it has information like the amount of expenditure, the amount of revenue, the deficit, which means the borrowing, right, each year. So Parliament has to approve that document. So it's produced by the National Treasury, it's tabled. The Parliament is supposed to debate it, and then approve it with or without amendments. So there's an opportunity for the Parliament to say, to have a say in what is borrowed, right, and how much is borrowed. So, and of course, these parliamentarians are people that we elect, right? They're accountable to us. So I would also emphasize the role of citizens in becoming aware of public debt, because these loans that we talk about very openly here, the Eurobond, they're loans that we're going to be paying. I mean, I'm assuming from what I can see, the average age in the room is about 25, 26, right? And we talk about something like the first Eurobond, which is almost a 10-year bond. And you look at also the average age or maturity of some of the loans that we've been taking. These are loans that us were going to be paying back, right? Us in that kind of age group. So I would also emphasize the role of citizens in being aware on public debt, and also being alive to the fact that parliamentarians do have a big role in how debt is procured and how much is procured, and they're accountable to us, right? So when there's a call for public participation by the National Treasury or your county treasury, it's important to still engage, right, on matters of public finance and matters of budget. So, for example, a decision that's being considered now is the Division of Revenue bill, which is another decision along the budget cycle. And these are decisions that feed into each other, right? So the typical budget year starts with the release of the budget review and outlook paper. That turns into the budget policy statement later on, through after the sector hearings. Us as citizens, we can also engage in. On the strategy, so alongside the budget policy statement, the National Treasury releases a document called the Medium-Term Debt Strategy Paper, right? And the purpose of this paper is essentially to say, this is what we need to borrow in this year and over the medium term, which is 2 to 3 outer years. And this is how we can go about it. So it's about strategies. So there are normally 4 strategies that are proposed, and 1 preferred strategy is selected for the current financial year. And so that's a key document in terms of what are the risks associated with public debt. So some of the risks that are mentioned in that document is refinancing risk, refixing risk, the interest rate risk, the foreign exchange risk. It can get quite technical, but that document has a lot of information on how government is planning to manage its debt. So I'd implore you to go and look at that. It's also on the National Treasury website in the public debt management section. And again, this ties into the idea of future generations, right? So I think it's actually in the Constitution that borrowing should be done in consideration of the burden that it places on future generations. And so perhaps what we need is a long-term borrowing strategy, right? Because the medium-term debt strategy is released each year, so it's released annually. So do we have a 10-year strategy for how we're going to borrow, right? Because that would give parliamentarians and citizens a sense of certainty on what's going to happen. So recently, it's not impossible, because recently this happened in the tax sector, right? In tax policy, where we got the medium-term revenue strategy, which actually tells you each year what tax reforms the government wants to introduce through the finance bill. So why not have something like that for public debt, right? So I think that's one of the things that is worth focusing on. Yeah, thanks you, James, for your question.
So there was a question on balancing borrowing in the short term vis-a-vis the long-term charter. Which is more beneficial? Do we borrow now and pay back later, or do we go for long-term loans?
Well, it's nuanced, and also you're looking at the kind of expenditure or the kind of requirement or the kind of needs that needs to be funded by this whatever borrowing that you're getting yourself into. But it's a choice that even National Treasury has. And during the course of this debate, I've been talking about treasury bills. These are pretty much short-term instruments. You can get it within 91 days, 182-day T-bills, and 364-day T-bills. And then we have the treasury bonds, which runs the ambit between 2 years all the way to 25 years domestic side on the domestic borrowing. And if you look at it in terms of the longer the bond, treasury bond, the higher the interest, the financing cost to it. Because the argument is, as a lender, I'm giving the government X amount of money, but I'm not sure whether the government will now be able to pay it. So what you call the term premium. So you start from, if 1 year T-bill is at 16%, but I'm giving you for 10 years. So I need to also put I need to get some compensation. So I'll demand more. So I might take 10 years I will want 18%. just for instance. So it's incumbent upon the government now to, okay, it has borrowed money at 18%, but now in terms of sustainability, how will it deploy this money that it has received, and to ensure that after 10 years, it will now be able to repay it back and sort of breaking even whatever investment it has gotten itself into. So it's a tight balancing act, and more likely than not, you find that governments will want sort of to spread it. They want to borrow long term, but ensure that they are borrowing long term with a reduced financing cost. So that is some of the trade-offs that they're trying to do. But as it is in the current environment, whereby if you take a step back, we had COVID-19 risk coming in, and then we had economic starting to grow since 2022. And then right after that, we had Russia-Ukraine war coming in, and inflation increased, one, because of the supply chains concern, which impacted oil prices, and also the fertilizer, Ukraine being one of the main producers of fertilizer, so being impacted. So find that inflation has been on the increase, and one of the policy interventions that has been there, so as we are not having a higher inflationary environment, one, and also inflationary expectations not to be quite entrenched on the upper side, is now we've seen that the monetary policy coming in to increase the base lending rate. As at the start of last year, we started at 8.75%. As at the end of last year, we ended at 12.5%. So that meant that even all these other pricing that are done also increased. So it's a bit of a trade-off, but right now, expectation is that now probably you could see the cost of financing will start gradually trending lower. I think there's a question that Karaoke had raised around Eurobonds and potential risk on Eurobonds. But one of the things that stand out with Eurobond and also the external borrowing is now the exchange rate risk. When we borrowed, when we had our first Eurobond, that is 10 years ago, so there were two Eurobonds. We had a 5-year Eurobond and a 10-year Eurobond. So the 5-year Eurobond, we repaid it in 2019. So when we borrowed this, when we had these Eurobonds in 2014, the exchange rate then was 87.5. 10 years later, in February, exchange rate had gone to 160. So that is the main risk, that you are borrowing in dollars, because we borrowed this 10-year Eurobond in dollars. We got it, converted it at 87.5, that was around 170, thereabouts. And right now, when you are repaying it, we need to get some 320 billion. So that was the headache. So the exchange rate risk is quite big over there. And also, we need to be alive to the fact that borrowing a Eurobond is in commercial terms. You're not getting the low interest rates that IMF and the World Bank gives us, which we call concessional financing, but you borrow on commercial rates. 2014, the interest on that 10-year Eurobond was 6.875%. This time round, because we did what you call a liability management buyback and all that, so the bond that we borrowed recently was 9.75%. So that is the commercial terms, the interest at this point in time. So that is something that also people are alive to, that borrowing from the Eurobond market tends to, as opposed to the concessional loans, tends to be at higher rates. But now the good thing, quote unquote, a lesser evil is that unlike borrowing from some of the multilateral lenders, you don't have the conditions, you're not required to do all these things, cut your spending, you're not to increase your taxes. So there's a bit of some flexibility for governments that get into the Eurobond vis-a-vis now the IMF, that it's like no strings attached. But also, the IMF will be keeping an eye, the Eurobond holders will be keeping an eye on the government. So there are normally some meetings that they have with the government just to ensure that they cannot also be able to get their money back. So things look at, are they also in track with their IMF reforms? Are they also reducing their budget deficit? So are they containing the inflation? So things like that is what is also measured by the Eurobond credit holders.
Just to be clear, when you talk about commercial interest, you mean that the interest does not change?
It means that the interest is on commercial terms, in the sense that if you go to a bank as a borrower, they won't give you at 3%. They look at you and say, based on your risk profile, based on your risk appetite, or the kind of need that you need to finance, they'll give you at 10, 20%, give or take. They look at where is the benchmark rate as it is right now is at around 13%. And obviously they need to put some based on your CBR rating and everything. So they'll give you at a market rate. So that's the commercial rate that I was referencing for Eurobonds.
All right, so you're watching Kenya's Eurobond debate. This is our third debate in 4, and today we are weighing up whether relying on debt is a sustainable economic strategy or not. So moving on, Cuba, there's something you mentioned. You kind of lightly touched on it. You assumed we would not notice. We noticed. You say that IMF helped Kenya avoid default. So the question is, how close did we actually get to defaulting on the Eurobond?
So the proximity to default, as you say, it's something that we grappled with as civil society organizations. So, of course, the International Budget Partnership is part of the civil society, and we focus on public finance, matters of public finance. And one of the things we noticed in 2015 is that when you look at the government's balance sheet in terms of the loans that we had taken and the ones that were due, that 2024, which is the year we're in now, would be a very difficult year because you have a lot of obligations pending, right? So, for example, you had some of the payments for the SGR, you had some of the payments for, of course, this big Eurobond, the bullet payment. So, at the same time, coming closer to 2023, we had relatively low forex reserves, right, in the central bank. We also had issues with the cost of living, and there are a number of things that were done, and also the foreign exchange rate, so the Kenyan shilling depreciating quite heavily. So also the shock of what the Eurobond would be in this year started to hit, right? So of course the shilling went from 120 to a ridiculous kind of height, right? So it started to become more and more clear that something like that would happen, right? At some point, Ghana defaulted, right? So I'm like, hey, it's possible, At some point also Sri Lanka along the way. And so we're starting to see more and more economies kind of buckle under the pressure of public debt. Of course, and then in December we had Ethiopia saying that it's no longer going to pay any debt payments. And so it was a technical default because there was a domestic bond that was due and they just chose not to pay because they had an agreement not to pay their foreign lenders. So perhaps we would have come quite close, right? I do think there are a number of things that have happened even between December and now, or November and now, that kind of maybe reduce that possibility. So of course the additional funding from the IMF was one of those, which comes with conditions. There was additional funding also coming from the Trade Development Bank. I believe the CBK governor mentioned at some point. I think there was also more funding coming in from the Africa Development Bank. So it started to become, okay, maybe things aren't as bad, right? And I think a lot of Kenyans also quickly realized this when they were holding their dollars, and suddenly things started to flip. So perhaps we could have come quite close to a default, I would say. When you look at even just the journey of certain countries that have defaulted. So you look at the journey of Greece, the journey of Argentina. Argentina is a bit extreme, but they were along the same path where it was you have this unsustainable expenditure that causes you to borrow more, that causes you to borrow more to pay back what you borrowed, which is exactly what this Eurobond that we took this year was. It was to pay back part of the previous Eurobond. So perhaps we came quite close, let me say that. And I think it's a lesson for Kenya on what we can do different so that we don't end up in this situation in the future. And I think it's also related to your question around, do you choose short-term debt or do you choose long-term debt? Because what we've seen currently is just a kicking of the can down the road. So we borrow this Eurobond to pay back the other Eurobond. Maybe when the time comes for that other Eurobond, we'll take another Eurobond to pay back that Eurobond. Because even if you look at the history of Eurobonds, so according to the National Treasury website, Kenya has had 7 Eurobonds, right? So from the information that we can see from the Eurobonds prospectus that are available, the indication is that a lot of them, or at least the first and the second, were used to, or at least the second were used to be used to pay back some of the first. So there's a kind of a continuous trend that we see around Eurobonds that could have serious implications in the future if we continue along this trend. A default is not impossible.
Churchill, you seem like you are eager to jump in on this, but as you're doing that, I would also like you to also flip it a little bit and talk about the risks in defaulting. What would have happened if we really defaulted?
All right, so as I answer that, so if you talk about default, basically is that you have a debt obligation that is due, be it the principal or the interest, but you are not able to pay it, or you are just not willing to pay it. So from that context, probably I may just take a different view from Cuba, because we were looking at from a perspective of a defaulting on the Eurobond from that context. So we had a $2 billion that is coming due in June this year. But in terms of our capacity, yes, the metric that people look at is now the FX reserves. Up until right now, we are looking at $6 billion. So had we not done the liability management, the buyback, in a worst case scenario, it's just getting the money from FX reserves and paying it off. So you have 6 billion here, and then you pay it off. So just think about it. You have some spare money. You have a loan from a bank, but then you have some money that is hanging somewhere. Yes, it might constrain you to repay the loan from your ordinary income, but since you have some money parked somewhere, so you can just sort of remove it and pay off your loan. So that's kind of the situation that Kenya was. And from a worst case scenario that you're not able to, because ideally we are looking at a refinancing, because the interest costs had now already, it's all in hindsight, but the concern was that will Kenya be able to repay it? And people are looking at the FX reserves. So from that perspective, I think we will have sort of muddled through just basically paying off from the FX reserves and just contending with a scenario whereby we are at a lower FX reserves perspective. So, but now in comparison to other countries around, in terms of Kenya, IMF helping Kenya to avoid default, this is coming from a perspective that if you compare with Ghana, by the time they were defaulting, and this is also another comparison, they first did not default on their external debt. They first defaulted on their domestic debt. And this is a point that needs to be quite clear. So they were not able to get the necessary revenue. They did not have an IMF program in place. So they were not embarking reforms. So in December 2022, since they did not have an IMF coming in, they did not have an IMF program in place, they announced a domestic debt restructuring. So basically, the interest rates on their domestic debt was 20% T-bills, 25% on treasury bonds. So it used to gobble a lot of their revenue so as to be able to service these interest components. So that was the issue that now led them to default first. Right now, they're talking about external debt restructuring because this whole thing about common framework. If you've defaulted on domestic debt, also need to default on external debt. And that's also the issue around Ethiopia. They have signed up into the common framework. They had an agreement initially. So, I mean, they just were required to pay $30 million. That's pocket change for an economy such as Ethiopia. But now they've defaulted that just because of the fact that they are within the common framework. So the difference was that unlike Kenya, which was with an IMF program, Ghana was not in an IMF program. And because of that, you find that even the external financing on Eurobonds or the kind of yields, the interest rates that was there in the Eurobonds was quite elevated vis-a-vis Kenya. So that's the difference. So now takes us to the point, in the event of a default, what is the likely debt that Kenya might default? I think, and I believe that it will now be following the Ghana case. defaulting on local debts. We are at a scenario whereby for every total interest in any given financial year, 80% is now financing domestic debt. So that is where the elephant in the room is. So unless now we see measures that are being put in place to ensure that the domestic debt servicing cost or the interest on the domestic debt start to come gradually so that it now be able to ensure that it's quite durable, we might avoid a domestic debt scenario that Ghana found itself in. Back to you.
All right, with us is Ndii. He is the Chief Economic Advisor to President William Ruto. He has also previously worked as Economic Advisor to the President of Rwanda, Chief Economist for Equity Bank, an economist with World Bank, and has taught at the University of Nairobi. Ndii, let's just get you up to speed. The conversations over the last 3 debates have been very hefty. And one of the questions that have come up is, do Kenyans actually really know the status of our debt?
Country is diverse. It has 60 million people. It's unlikely that all of them understand our debt. Public debt is also quite complicated. So by and large, I think outside, even many people who comment as experts, you find that because public debt is quite different from the way private debt is, there's a lot of misunderstandings. For example, I see many people asking me why we are not paying down the debt. And I tell them, in general, states don't pay down their debts. It's not a smart thing to do because states exist in perpetuity, unlike individuals. And there are people willing to hold public debt. There are always people who are willing to hold public debt. So, given so much demand on public money to provide services, and people are willing to hold your debt, it would not be wise to spend money on paying down debt at the expense of providing better education or healthcare or more infrastructure. So that's a very fundamental difference between public and private debt. So that what really matters, and what you really need to ask the question about public debt, is about the carrying capacity of the debt. How much debt can a country, can the state sustainably carry? And then that gets very technical. We have recently changed the debt anchor that we use from a public finance accountability perspective from an absolute figure for good reasons to something called the net present value of debt, which better captures the concept of debt carrying capacity. So when you get to that level of technical complexity, it is not realistic to expect the general public to have a full understanding of it.
I think the question where the majority of the people were coming from was in terms of, do we actually have about 11 point something trillion, or is it more? That was the question. Is it the actual figure that the government is pointing out? Is that the actual figure?
That's true, reflects the failure to understand the debt, because that figure changes every day when you have debt in foreign currency. When you have debt in foreign currency, so your debt will revalue when your shilling appreciates. For like now, you will see that if you use the current exchange rate, the foreign debt is much less in shillings compared to 3-4 weeks ago. Again, it's not, that's the point. It's not a very meaningful number, what the absolute total of debt is. Which is why we often talk about debt as a percentage of GDP, but even that will fluctuate with exchange rate. It's also not a very meaningful number, hence what I talked about, the net present value of debt.
I wanted you to jump in on this. We just spoken about it, and there are some pointers that have been included in terms of how close did we actually come to defaulting on the Eurobond in the 2014 Eurobond. How close was the country into defaulting?
I think to understand the circumstances and why the Eurobond 2024 issue has become so big an issue and elevated, Uh, when country like us borrow from the foreign markets, or any country, in fact, not just us, when the difference between the important difference between bonds and bank debt, for example, which you amortize, is that the risk you run with bonds is called a refinancing risk. Because you do not amortize, the risk you run is that when the maturity comes up, will the market refinance the bond? Now, two things. What happened and why this particular Eurobond was a very significant issue is that, as you were aware, about a year and a half ago, global interest rates rose very significantly. US Treasury bond interest rose benchmark rates from below 1% to about 5.5%. That meant that the markets became literally closed for what you call frontier issuers like ourselves. And it increased the refinancing risk. We would be able to refinance. But more significantly, that particular bond maturity was very large. It was the single largest maturity from countries at our level, what we call frontier markets. So if you read the literature on the sovereign bonds, particularly of emerging and frontier markets like ourselves, you will read about the concern about what they're calling a debt wall in 2024. Very, very large maturities, which are bunched up around 2024, 2025 for Africa, Latin America. There's quite a limit. But in 2024, ours was the single largest. So you combine two things, change in market, a liquidity shock in the market, and Kenya having a very big bond issue, as well as many economic vulnerabilities. We're coming out of a drought, political change. So there were very, very many factors that underpinned that issue. Most of them external to us. But the only significant thing, and I think which I raised 10 years ago when that bond was issued, was the size. It was not prudent to have such a big outsized maturity. And it is at one time, because the refinancing risk is bigger the bigger the maturity. And hence you can see even the buyback liability management transaction that we did, we have broken it down. The 1.5 billion, we broke it down to 500 million maturities over a 3-year period, so you don't have to repeat that experience of having a $2 billion bond maturing at the same time.
All right. So just a reminder once again, at 8 minutes, you'll hear this chime. And at 10 minutes, you'll hear this. That means your time is up. Churchill, there was a question here. We have talked so much about why we are in debt and how we got here. But the question of, is there the discussion about decreasing expenses and only focusing on increasing, rather than just focusing on increasing revenue or tax brackets, would that even work?
It's quite nuanced, and even the experience over the last fiscal years just shows us that it's quite a hot potato issue, because the various state actors, be it from the executive, been showing commitment or intent that there could be fiscal consolidation in the next budget year. And obviously, we normally have some revisions within the budget year, which now tends to increase even the spending. And right now, in terms of tax revenue, the current administration is quite keen on ramping up the tax revenue. It's quite commendable. You can argue that it's because we are within the IMF program. One of the conditions is now to ensure a fiscal consolidation that is biased towards increasing the revenue. But we've seen the numbers for the current fiscal year, the first 8 months up until February. It's just telling us that we will miss that revenue performance by a mile. So now that takes us back to the drawing board. We are looking at implementing a medium-term revenue strategy from the next fiscal year all the way to fiscal year ending June 2027. And just looking at the numbers, we are expected to increase the ordinary revenue. By ordinary revenue, that's the tax revenue, non-tax revenue component, from 14.3% as of June last year to 20% by June 2027. So there are a number of intended tax proposals that have been put in place so as to be able to ensure that there is some the individual state actors, there's some reliability in terms of these are the tax proposals that will be there, so that not people getting surprises during the finance bill process. So you might say that it's commendable, but you can also say that it's quite audacious in terms of growing, reducing the fiscal consolidation, getting into the tax revenue. And I'm pretty much sure that our senior in the panel, this medium-term plan, we've talked about it, that there was a delay in terms of bringing to the public the medium-term plan for between 2023 all the way to 2027, which is also coinciding with the end of the medium-term revenue strategy. I understand that that particular report was launched today. I may be corrected, but we might also dig deeper into that so as to, because I'm pretty much sure that the aspect of tax revenue collection, in as much as we have the medium-term revenue strategy, we have the national tax policy in place, it also embedded within the fourth medium-term plan 4. So I'll be quite keen to see what kind of policy measures or policy thinking around revamping our tax revenue is in place. Obviously, in terms of spending, now gets into the efficiency pretty much. We're at a scenario whereby the stock of domestic arrears, public pending bills is close to 600 billion. So, and it's sounding like a broken record each and every time you look at the budget committee reports saying that the ministries, department, and agencies, they need to prioritize settlement of the pending bills, but that hasn't been the case. We've seen it actually growing. There's a proposal by our esteemed panelists in terms of securitizing the pending bills. Right now we have a pending bills verification committee, just sort of to scrutinize the pending bills, and it's going all the way from 2005 up until right now, so that you can now be able to get this visibility on what are the authentic pending bills that needs to be cleared. So in terms of spending, it's quite, it's the hot potato issue in the room. So if the government is now able to address that, we can now be able to see some form of debt sustainability going forward. Yeah.
Same question, Cuba.
Yeah, I think, like Churchill has mentioned, there's an importance in focusing both on expenditure and on revenue. But allow me to be biased here and focus on expenditure, because one of the things that we do at the International Budget Partnership is try and unpack what it means to actually allocate money to a certain sector or to a certain program, and whether there's actual value for that money. So, you know, as has happened, you know, we've been in this space for 10 plus years. There's usually a lot of engagement and a lot of conversation around the budget policy statement, the budget estimates. You know, the Minister of Finance comes and reads his very great speech. But then after that, there tends to be a lot of silence, right? Which is contrary to what you'd expect, because that money is being spent past, you know, June 30th. So the budget has actually been approved. So the ministry, departments, and agencies and county governments are meant to start implementing the budget. But, and that's the point at which now the allocated money becomes, you know, money that's actually spent and realizes service delivery. So I think there is an importance of not only focusing on the formulation of the budget, but also the implementation of the budget. So not only the allocation of the expenditure, but the actual spending, right? So of course, the Control of Budget releases quarterly implementation reports at both the national and county level that are available for citizens and members of parliament or the county assembly to actually engage in and use that to kind of to assess how we're doing in terms of expenditure. So I do believe there's a conversation there around accountability and the efficacy of that money that we allocate every year. There's also the issue of, I think Churchill also alluded to it, but the issue of in-year deficit increases, right? So this is, for example, the current financial year, we had the budget, the approved budget, on June 30th for the financial year 2023-2024. Then soon after, I think less than 4 or 5 months, we had a supplementary budget, which we saw increase the amount of expenditure that the government actually wanted to do in the current financial year. And this is a trend that goes back a number of years. In fact, in 2014, the increase in the budget deficit of the year was about 99%, right? So what the budget deficit was in the BPS and towards the end of the financial year. So that we do believe has contributed to us perhaps borrowing more than expected in the specific years. And of course, there is a report from a special audit from the Office of the Auditor General on supplementary budgets that kind of finds similar conclusions on are these increases, I think it's Article 223 of the Constitution that kind of allows these supplementary budgets, but are these increases or these changes within a year actually justified, right? So there's certain conditions under which these are allowed, unforeseen expenditures. So for example, we saw supplementary budgets during COVID-19, but even the justifications that we do find in these supplementary budgets are often not forthcoming, right? So we're not able to see what the additional expenditure is. On revenue, perhaps if I can touch on it, it's also about the realism of projections, right? So of course, we're having a conversation now about the division of revenue bill. It's currently being debated. So there's the idea of, if we ambitiously set our revenue targets, we're bound to fall short, like Churchill mentioned, which increases the size of our deficit within year, also from the lower side. So I do believe there's things that can be done on both sides to kind of change that. I also did want to mention, so there's a lot of conversation that's been there around, particularly in social media, around traveling expenses, right? And how much, not only county governments, but the national government is spending on traveling expenses. I do believe that as much as it's a very small percentage of the budget, I wish that energy that's spent on focusing on travel expenses could be spent on other areas of expenditure from national and county governments. So there is a question, of course, of accountability there. So are we actually getting value for money in terms of what the government is spending on? But I think it's still open to debate.
David, same question, and if you have any response to some of the issues they have raised as well, in terms of why are we not even talking about decreasing our expenses and focusing more on increasing our revenue?
Okay, big picture. Let's go back 10 years ago, struck fiscal framework. We were spending about 21-22% of GDP. Revenue was about 18. So basically, you're running a budget deficit of 3% of GDP, which is sustainable, depending on how you finance it. If you do that 50-50, 1.5 to 2% of GDP, you are not crowding out the private sector. Foreign, you are borrowing 1% of GDP a year. You are not, and so your debt is actually, if the economy is growing at 5 or 6%, your economy is growing faster than your debt. You can live with that. Where are we now? When we took over, expenditure still 21-22% of GDP, revenue 14% of GDP. So your deficit has expanded to about 8% of GDP, and we have run that for a good 6-7 years. Now, so clearly the expenditure level has not changed. So we don't have an expenditure problem in terms of macro framework. We may have expenditure composition issues, what you're spending it on. And you could get better value for money on the expenditure side, but you don't want to cut expenditure. You don't want expenditure compression. At our level of development, you have benchmark numbers. We really should be spending something between 24 and 26% of GDP to be able to invest the public infrastructure that you need, public goods, and also to deliver services, so as not to have your doctors on strike every time. So that's about where you should be. And if you're going to have a sustainable deficit, you have about 3% of GDP, and you expect just 24% of GDP, then you need to be collecting 21% of GDP in revenue. So you do have a revenue problem. And wasteful spending is diversionary as far as the macro framework is concerned. Yes, so what you're saying is that the money that is being spent on traveling should be spent on paying interns. That's a different issue. But what level of spending? Is there an issue with the level? No. You don't want a contractionary consolidation, because then that begins, because that has aggregate demand issues around it. If you compress your expenditure and you don't have a private supply response, then probably your GDP begins to fall and you end up into a downward spiral. Why did revenue fall? The reason why revenue fall is, as a ratio of GDP, is two things. One is that because of that borrowing in itself, when we went onto this infrastructure-led, debt-led, massive infrastructure spending, that has GDP impact. It's expanding your denominator of GDP, that investment that you're doing with debt, but its tax yield is very low because it's public spending and government can tax itself. So part of the decline in revenue to GDP is because the government is crowding out the private economy. So it is government, it is growth of government, which is not, and you see that reflected in productivity. You see, in fact, if you decompose GDP growth over the last decade, what you see is contribution of government has increased very significantly, and contribution of private investment has fallen very significantly. In fact, 10 years ago, if you got 5% growth of GDP, it would be 80% private sector, 20% government. Now it's about 50-50. And of course, because if there's a government component of GDP, which is growing, that does not have as much tax yield as if it is private sector. So that's a rebalancing that you need to do in terms of your fiscal framework, and that's what we are trying to do. So when we say we are expanding the tax net and changing, you must be able to get to the only way that you can actually sustain the things that government needs to do, and also be able to have a sustainable financing, is to expand the revenue base. There's possibly no ways about it. The alternative is to shrink government spending. If your revenue is going to stick at 14%, then you need to shrink public expenditure to 17%. Now, if you shrink public expenditure to 17%, then you have to ask, what do we cut? Now, that is not travel. That is not frivolous. That would mean cutting expenditure on education by half for you to begin to get those kind of numbers. Yeah. So I think when we sometimes disappear into rabbit holes about some travel expenditure, wasteful things, and it's all absolutely true. But that is an allocation issue. It's saying that money should go to other things. But in aggregate, we really should be looking at actually probably increasing our public expenditure to something like 25% of GDP, which then means you require at least 21, 22% of GDP in revenue.
So the government at the moment, you've mentioned it, is borrowing at about 18%, and to some extent is crowding out the private sector. What are you doing about it to ensure that at the end of the day, yes, you're borrowing at this rate, but you're not leaving the market so closed to yourselves?
The reason why we are borrowing at 18% is because interest rates do many different things, and one of them is monetary policy, which has absolutely nothing to do with your fiscal side. And the reason why expensive because US interest rates went up. So if you look at the spread between global interest rates and our benchmark rates, when the US interest rates were 1%, our domestic CBR was something like 7, 8. So that means that you're borrowing later about 12, 13. If US rates reach 5, 6%, then you have to stay with the curve. If you don't, so if you look, the spreads haven't changed much. You have to stay with the curve. If you don't stay with the curve, then you get massive capital flight because you are integrated into the global financial system. And that's why your shilling then probably weakens beyond what is fundamentals are dictating. So the interest rate here is doing the job of managing external shocks. And if that is the case, as a small open economy, then you have to bear the price. That's how you deal with shocks. And then when the shock subsides, everything else goes down. So there will be a tapering of interest rates as well. So you have to factor in that there is a macro stability side that you have to mind also, not just the fiscal side.
Quick follow-up before we come to their questions. You talked about us having moved the way we peg our debt onto GDP now. The question we'd asked earlier and some of the responses we got, similar question to you. Why not peg the limit to revenue collection levels instead of the way we are pegging it at the moment to GDP?
In a way, that revenue is building. When you move to NPV, how that NPV, you need to look at the formula of that NPV. And that's precisely the reason to moving to that, because it has, it's a sort of your carrying capacity of debt, if we may put it that way. And revenue is one of the components which is in it. So that's precisely where you've got economic growth, you've got revenue, because what you're doing as an NPV of debt is you're forecasting your revenue, and in fact your capacity to pay, which is your revenue, your foreign exchange, in terms of external debt, and you are basing that on the size of your economy and what you're doing in terms of revenue, percent of GDP, and then you are looking at your debt repayment profile, and then you are discounting that to present value. It's a bit more complicated than that, but it's precisely what you're trying to do.
All right, quick one. So there are questions from Jack, from Kemu, Raphael from NIBS, also prepare yourself. Let's give them mics. Emmanuel from ZTech as well, and Mwikali from ZTech. So, Majak, where are you? He's up here.
Good afternoon, if I'm not wrong. We have been down here. My name is Marabol Majak. I'm from Kemu. My question was about the public debt. I was asking, what are the consequences in terms of economic in the current financial year 2023 to 2024?
Okay, just speak.
Hello, I'm Raphael from NIBS. My question is, what does it mean for a country to have a debt limit and what impacts on its economy?
David, you take that. Where is Emmanuel?
Having that we as a nation, we depend on public debt for financing our project. One of the fundamental issue, a reason why we go for debt is for, let's say, for infrastructure. And one of the reasons we say that our government is not accountable. We benchmark in other nations so that we can get on what we are doing with the public debt. If you see, for instance, we use the public debt to build the expressway, while in the other countries such as Singapore, they use the same debt for infrastructure. But to look at the case in Kenya, but we are using the same funds, doing the same thing as other country. Yes, they are making it, but we are not making it on this side. So where are we not doing it right? Having in mind that we are benchmarking, doing the same thing with the same fund as the other nation.
Where is Mwikali? Mwikali? Yeah.
My question is, since we should rely on debts to improve as a country, If our strategies to reduce adverse environmental and social impacts fail, why don't the government re-strategize the strategies that they're using?
Okay, why don't we change our strategy, debt strategies? Churchill will take that. Let's start with you, Cuba. Just 3 minutes, please. All right.
Thank you. So the question from Jack was, what are the economic consequences of debt? So it's quite a broad question, so there's many places that the answer could go. But one of the ones that perhaps we can focus on is the fact that these debts have to be serviced as and when they come due, right, over time. So what we have seen over time is that the amount of ordinary revenue that we're spending on servicing these debts each year is increased. And of course, one of the consequences of that is that the amount of revenue available for other purposes, for expenditure, for giving to county governments, for expenditure on health or education, is limited, right? So you could say the service delivery or socioeconomic impact of that is that perhaps we're not realizing the services that, we are not adequately financing the services that we do have. Again, like I mentioned, that it's a bit of a circular argument because debt is also borrowed to pay for those services, but debt is also borrowed for development, right? And ordinary revenue is split between recurrent and development. So when you do have more of your so the debt servicing obligations are recurrent, right? So they're in the consolidated fund services. So the more of that you spend, so it's kind of the size of your spending on debt and kind of the recurrent expenses does have an impact on the amount of revenue that you have for other recurrent expenses, right? We would all like to assume that money that's borrowed according to the law is actually being spent on development and is not going towards recurrent. So that's one of the consequences that we tend to focus on at the International Budget Partnership Kenya. There is some that have been mentioned already around the crowding out of the private sector, the fact that if a default was ever to happen, then you do have an impact of the main bondholders in Kenya, which would be banks and social security funds. So there are many broad consequences, but I think the one that we tend to focus on is the impact on service delivery in terms of debt servicing obligations.
David, your question was on limits on debt.
Okay, I think allow me to just make a general observation about development finance, because it speaks to all the questions that have been asked that you referred to me. Poor countries or low-income countries at our level have a development finance problem in two parts. The first part is that you need to invest more than you save. Your investment needs exceed your savings. And your savings are low because you're poor. You live hand to mouth, just like individuals. A poor person cannot save much because they're living hand to mouth, and so it is with a poor country. But your investment needs, and in fact the opportunities to invest and improve your income are very high. The returns to investment are actually very high. So that's one of the reasons why you borrow, because you have investment opportunities that exceed your capacity. That's one of the premises, that returns to investment are very high. The second one is that you need to import more than you export. The reason why you need to import more than you export is for the same reason, because to invest, you need capital goods, what we call capital goods in economics, and you don't produce capital goods. So you have to buy them from other countries. Whether we are talking about tractors for your agriculture, turbines for your electricity, computers for all the other things that you need to do. So even if you had domestic savings, you would still need foreign exchange. Those of you who have studied development economics will have come across savings constraint, foreign exchange constraint. So borrowing is a necessary part of development. Yeah, so let's start by that point. Public debt is a necessary part of development. The second point I want to make is in reference to the current Kenyan public debt kind of distress. The real challenge with the current situation, as I said, is we started out with a deficit. 10 years ago, the previous administration increased the public deficit, budget deficit from about 3% to 3%. In fact, the Kibaki administration, we did run, in fact, a couple of balanced budgets. And it increased this to 8% per year. Now, there was actually nothing wrong with what they did in principle, because what the administration did, and not this only one, is that finance became very cheap in the global market because of something which was called quantitative easing post 2007 financial crisis. Money became very cheap in the global market. And then that supply side from the global market, and then there was a new development called China, which was also willing to lend the developing countries a lot of money for infrastructure. So many developing countries, which were finance constrained before, thought that this was a huge opportunity for them to build, to expand infrastructure. And indeed, if you look at Kenya and many other countries over that period, we have done the biggest infrastructure building that we have seen since independence. The challenge is a mismatch between the returns to that investment in infrastructure and the debt structure. So we have used debt which is of a short to medium nature to finance investments which are of a long-term nature. But given the fact that these countries had been very finance constrained to do that before and to build infrastructure, we had to go to the World Bank and jump all sorts of hoops just to do 10 kilometers of road. Once the countries saw the opportunity want to go, China was willing to lend you a lot of money and actually do huge infrastructure projects. We could go to the market. Those of us which were a little more advanced like Kenya could go to the market, and instead of waiting 3 years to develop a World Bank project, you could actually go to the market, borrow your own money, and do your, and it's true, within that period, Kenya doubled its tarmac road infrastructure. These investments will pay off in the end. But in the short term, it means that you have a mismatch between your investment and your debt repayment. And that's the rebalancing that we are trying to do. Our approach is to say, we have actually done a lot of this investment. True, there is some money, and what happens is now when you're doing things too quickly, you don't always tend to do the best projects because you're doing too yes, the quality of projects that you choose, there will be corruption. But by and large, everywhere I go across Africa, a lot of that money has actually ended up in physical infrastructure you can see. Yeah, that's the big picture. The question is then, another thing happened. It was unanticipated. The reason why then money became expensive all of a sudden, what was the reason? COVID. Nobody saw COVID coming. Nobody could have seen COVID coming. Yeah? So there was an assumption in the global market that interest rates were going to remain very low for a very long time. Then COVID came. Countries had to do all these fiscal stimulus, supply constraints, upsurge in inflation, activation of contractionary monetary policy, lots of stories. So, in a sense, there are, again, sometimes we get to look at one project or there was corruption here and there, but just using your eyes physically, you can see that actually a lot of infrastructure has been built. I talked about the expressway. Incidentally, the expressway was not built by debt. It's actually a PPP project. So government did not actually put that money in it. But what we're doing as the administration is we have recognized then that because our debt headroom is now very low, And we don't as a public debt, but we still need to do a lot of infrastructure, particularly in areas like irrigation and water, also for resilience purposes. We've seen the huge drought shocks. We are now putting up structures where we can make PPP and private, attract more private capital, so that, in a sense, you shift much of the infrastructure financing from debt to equity. It is not cheaper. In fact, equity is more expensive for those of you who do finance, but it doesn't carry the same the payment risks as debt. So either way, whatever. So I think sometimes when we just focus on the fact that you have a debt distress situation, we don't ask yourselves, what are the circumstances? What actually was the government trying to do? How did we get into that? I think the countries, if there was an error of judgment, is doing too much too quickly. But the case of the market standing all of a sudden, I don't think that was foreseeable by anyone.
Does it mean, from where you sit at the moment, Kenya's debt situation is not that bad?
It's not that bad. It was never that bad. The challenge was the liquidity shock in the global market. That's the only thing that caused the challenge. And you see, once the market opened, I started getting information from friends who are in the financial markets that they were seeing positive signs around Christmas. And you can see by a month later, we went to the market because we were ready. We had said once the markets open, I think in November when we appointed a transactions advisor in late October, many people laughed at us. Said, what are these people doing appointing a transactions advisor and there is no possibility of going to the market? The reason we did is we said, let's be ready. So that if the markets open, we refinance that Eurobond and get out of there. So once we went, refinanced it, everybody is asking, why is the shilling strengthening? It was just those market uncertainties that were holding the shilling. Yes, our debt financing, whatever, is expensive. The cost of domestic debt is significant. But again, that also has to do, as I said, with the global interest rate structure. But those are things I think we will be able to slowly ease out of the system within maybe another 12 to 18 months.
All right. Churchill, you seemed like you wanted to respond.
Just picking up on the question that you threw to me from Mukali around the debt strategies, if I got the question correctly. We are in an era where we get the medium-term debt strategies, but it's quite funny because it gives us an overview pretty much synced to the budget policy statement. So the next fiscal year and then some 2 more fiscal years after that. So on a 3-year time frame. But now the problem is, just think about it like having 5-year strategy plans, but then you keep changing it each and every year. So it doesn't kind of make sense. So one person can argue that there's a bit of some nimbleness because of the outturn of the previous year. So people are re-strategizing again. But if you can get that the debt management strategy sort of cast in stone, similar to the way the medium-term revenue strategy in our thinking will be sort of cast in stone for the next 3 years, will give a bit of some visibility and also the reliability that this is the plan that the government is doing. But having said that, I agree with the doc in terms of the buyback that was done. I think it was something quite spectacular. I'm a market participant, one of those people who was looking at the Eurobonds with a front row seat. I did not anticipate it, so we really need to commend the government for pulling that, because there was that layer of risk from in terms of a strategy. This $2 billion, will they be able to pull it based on the reasons that we had alluded to? So that buyback, it was quite remarkable in my view. But over and above that, some of the strategies that are in place, Doc has mentioned even the public-private partnership as one of the alternatives, just to ensure that, well, if this debt issues with the revenues or the revenues that are accruing from the investment projects are not even matching. So what are the alternatives? So PPPs are one of the best route to even look at exploring, and also the privatization. Though I feel that the pace of ensuring that that privatization has been quite slow. The new administration came in, or rather the current administration came in, and then we're given a timeline. Then over the next 12 months, we'll see 10 or 5 to 10 issuance even coming to the capital markets. So that we haven't quite seen. But I think if you think about it, that from the proceeds of privatization, you can now be able to finance your budget at any given year. I think that sort of kind of makes sense in terms of that thinking. And one of the things also, if you talk about sustainability, is now the cost of the borrowing. And just to throw it back to the administration, and this is back in November 2022, none other than the president said that going forward will not be borrowing more than 10%. Obviously, this is all water under the bridge. T-bills around 16%, T-bonds 18%. But one of the things that was put in place was Sanduku Investment Initiative. So basically, looking at the pension industry and finding a way that pensions, which are holding the savings in the economy, can now be able to finance some of these investments rather than the debt cycle that you normally have, getting money to finance projects. But so there was an initiative or a proposal within the Sanduku Investment Initiative so as to be able to go directly to the people who are holding this money so as to be able to finance the projects. But now the thing is, if you're looking at something below 10%, the kind of returns to pensioners, I mean, it might not be was not justifiable. So probably that speaks to that particular initiative not having taken fruit. So that's something that probably we may be able to see the government tweaking how they'll be able to bring it on board. But in terms of instruments that are also being explored from which has been there within the context of the medium-term debt strategies is also because Eurobonds, as it is right now, the market that was pretty much shut was the dollar Eurobond market. That's where primarily we get our Eurobonds. Basically, Eurobonds is borrowing outside your market, getting a bond not within the Kenya shilling denominated. So right now, all focus has been on the dollar Eurobond market, but I think also other markets have opened up. We have some Samurai basically issuing a Eurobond dominated in Japanese yen, and also Panda bonds on a Chinese yuan, Eurobond denominated in Chinese yuan. So those are some of the opportunities that other countries have explored. More so, Egypt has been at the forefront in exploring other non-dollar denominated Eurobond. A comment around exchange rate, which is quite interesting. Probably I may want to take a divergent view, is that in terms of exchange rate, we have seen some positive measures that have been done by the government. Before last year, the market that banks will be able to exchange, Bank A has excess dollars, Bank B has deficit of dollars. So they really need to come together so as to be able to match each other's needs. So that market had broken, the FX interbank market. So the government came in and sort of revived that market last year. And what actually we can explain to the weakness of the shilling over the course of last year was pretty much as this market, revival of the FX interbank market. So we saw that the shilling, the official shilling exchange rate pretty much coming to convergence with where the banks were. So in as much as you'd go and look at the central bank website, you see the shilling is at 120, but actual sense where you will execute it was around 130. So basically banks had sort of put some markup. So a significant chunk of the weakness of the shilling was pretty much on the convergence, this official rate pretty much coming to converging with where the bank's rate were now with the revival of the FX interbank market. So obviously there was some positive sentiment with the buyback that happened in mid-February. And what you've had, there was an infrastructure bond that was floated, the one that I earlier mentioned. And what we have had that there was some outsized interest by foreigners which came in. But right now, we really don't have the statistics to back it up because for one, in as much as there was an improvement in FX liquidity, unlike late 2022 and early 2023, if you would want to go and you want to access dollars, it will take you a significant lag time before that particular demand is met by the bank. But now with the revival of interbank markets, so it somehow is that, and also the efforts that the government did with government-to-government oil import deal. So, but still, we are still feeling feedback that FX liquidity issue has been quite, was constrained, and that also dampened even interest of foreigners coming to the equities markets. So I might not quickly jump into the bandwagon that because of the dollar, that the buyback that came in, obviously the money didn't even come in, the infrastructure bond, we've had various numbers in terms of how the actual foreigners came in as participating in the infrastructure bond. So I think that there's more that meets the eye. How the shilling improved from 164 to right now 139, I think we cannot really entirely put it to the buyback that was done. So probably there are some undertones that over time will now be able to give us some clarity. Probably, is it some government intervention? We've had none other than the governor speaking about in December and February monetary policy committee meetings that this exchange rate where it is, it has sort of overshot its target. So was there some intervention that was done? So that's something that we're still grappling with as market participants.
That was actually my next question for him, but we'll get to that. Cuba, you seemed like you wanted to make some remarks.
Yeah,
just quite shortly.
Yeah, sure. I feel like the conversation has abstracted quite a bit, but what I feel that most Kenyans care about, right? So if we were to all agree that the debt situation is fine, right? Or that we need to get expenditure up to 24% of GDP, I think what people are more concerned about is there value for money for that, whatever level of expenditure there is, right? So is there value for money for the Eurobond 1, for example, still in question? And I think it also speaks to my senior's point here about whether the debt financed infrastructure projects that we undertook over the past 10 years have actually realized a good enough return or value for money. So I think the question is, regardless of the level of expenditure, is that level of expenditure felt, right, from national government, from both levels of government, right? Does it actually realize the improvements in service delivery or in welfare or well-being for Kenyans across the country? So I think if we approach the debate from that perspective, then it becomes a bit different and a bit more nuanced than us just talking about kind of high-level numbers and expenditure. I just wanted to bring that aspect down. That it's also about, do Kenyans feel like there's value for money, right? I think a lot of this contention and debate around taxes and the Finance Bill of 2023 was a realization that the government does collect all these taxes and wants to collect more, right? Understandably, to deal with the debt situation. But do we feel like there's value for money for what's being collected? I think that's a part of the debate that is quite silent today.
All right. So David, there's a question here for you. Someone is asking, we have seen a resurgence of the Kenya shilling. Right now we're about 135, I think. So is this something that you have done? And I think Churchill has also asked you the same. Is this something the government has done beyond repaying back the 2014 Eurobond? Is there something else that the government has done to ensure that the shilling becomes stronger?
First, if you're running a good macro system as a small open economy, you want a flexible exchange rate. So exchange rate flexibility, exchange rate is your shock absorber for external shocks. So what you want is a flexible exchange rate. That's why you have a floating exchange rate. There's all sorts of economic debates around other things around that and whether you can run autonomous monetary policy. Now, the previous administration had shifted to a kind of managed exchange rate regime. In fact, there was it was the reason why the previous shadow program they had with the IMF collapsed around 2018 or 19. It was around the exchange rate regime, and Kenya was reclassified from a clean float to a managed exchange rate regime by the IMF. It's called other management regime. When we came, it was our objective to restore a flexible exchange rate regime, and we made that very clear. For several reasons, including the fact that we wanted to enhance our IMF program, and that was a requirement. If you wanted an enhanced IMF program for purposes of providing us a backstop, in case the market did not reopen for refinancing the Eurobond, you recall that we are one of the few countries which actually managed to get the IMF to commit to what they call, what do they call it? It's an extended sort of beyond quarter access. Yeah? And that requires a lot of jumping a lot of hoops, and therefore your fiscal hygiene has to be very good. And so we anticipated that right from the outset. The question was how? How do you move from that managed regime to a flexible regime when there is a dollar crisis in the world and rising interest rates? Another factor you need to factor in is because even though we talk about domestic and foreign debt, particularly in the bond market, dollar and domestic Eurobond and domestic bonds, when you have the kind of open capital account that we do, that distinction is actually sometimes superfluous because there is a huge amount of foreign participation in our shilling bond market. So foreigners do bring dollars, the foreign currency, and buy shilling bonds. So a lot of foreign people have shilling exposure, both in the stock market and we have free capital movement. In fact, if you look at the emerging market Africa currency, domestic currency bond indexes, Kenya domestic bonds are included in that index, most of the indices. So when you had an increase in interest rates, global interest rates, not only did you have a liquidity shock in terms of refining, but you had also outflow from the domestic shilling bond market. So we are also struggling with domestic liquidity in the domestic bond market because foreign money was no longer coming in, and that's why you are seeing shortfalls in the treasury bill and bond auctions every week. Okay, so that's by way of background. So what did we do? One of the first interventions we did to do this is a thing that has been trashed a lot by market players, the petroleum G2G. So that was the one thing which allowed us to build a currency cushion, a foreign currency cushion to restore a flexible exchange rate system. And the market reforms that he's talking about of bringing back the interbank market were because of because we had to build that $2.5 to $3 billion cushion so that when we restore the market, then you don't get sort of the kind of things that you saw in Pakistan and Egypt with their currency and what you're seeing in Nigeria with the Naira. But because of their political orientation, many of our market players were not paying attention. They were thinking with their politics instead of their analysis, their financial analysis. That's one of the first things. That also enabled us to begin to meet a lot of the external demand that was pent up. By late November, most of the dividend repatriations and all sorts of things that were causing problems for investors had actually begun to happen. The other thing, of course, is that once you allow the currency to float and then depreciate, it has a feedback loop to the system through the import side. So and the other thing you saw is the current account improving because of a slowdown in imports. In fact, if you look over the period, you had an import contraction to the tune of $2 billion. Yeah? And you could see that in the prices. You go to the market, all of a sudden, the expensive wines disappeared out of the market because you're not importing them because they are just too expensive. Wines which were costing 4,000 bob went to 10,000 bob and other things. You can actually see that transmission mechanism through the current account. And if you look at the data, you will see that the current account was improving. So there's a cumulative sort of things. And the other thing, of course, which began to happen on different sides is a huge recovery on FDI. If you look at in December, the FT Intelligence put Kenya number 3 on FDI outlook for Kenya in 2024. For the world, in the developing countries, I think we are number 3. And that's because already you began to see quite a bit of FDI activity. That is usually reported in the media, but people are not connecting their dots. So it was not a one-off. So the one thing which was remaining was the Eurobond uncertainty. But there was accumulation of things which were moving towards mitigating, attenuating and of course the other one is the interest rates. In December or January, we jacked up interest rates, the base CBK rate by 200 basis points. All those have to do with, so by the time we now opened, not just the Eurobond, but opened, I said markets began to open. So when you did the infrastructure bond, you actually had a foreign demand to the tune of actually $1 billion, 140 billion shillings in terms of the foreign demand. So the foreign capital was coming back, not just in terms of the Eurobond, but it has begun, you saw this reversal coming back into the domestic bond market. Yeah. So if you are paying attention and you are not wearing certain sort of lenses to see what you want to see, all the fundamentals will tell you that this was that appreciation was the depreciation was going to unwind. The question is just quantum. But I think there was also a huge speculative build-up of people who had assumed and made the bet that we were actually not going to be able to refinance the bond.
The second part of that question was this government, when it came in, it promised not to borrow anymore. Has that changed?
The government did not promise not to borrow. Again, back to the definition of public debt. I see lots of figures being floated around of absolute numbers. A lot of those numbers are refinancing operations. But you cannot say that the government is increasing the borrowing while your physical budget deficit is declining. Those two things are inconsistent. So if you're seeing a fiscal consolidation, it means that government borrowing is reducing. But if you are then reporting absolute numbers of debt transactions, which are refinancing transactions, some of them which are changing because of the movement in exchange rate. So part of the problem is, I think, among the people we call analysts, they are actually doing a very bad job of educating the public as to what exactly is happening. But as far as the government is concerned, if you have a fiscal consolidation which is on track, the thing you want to track is actually something called the primary balance. The primary balance is the deficit or surplus or of expenditure and revenue excluding interest payments. Why do you exclude interest payments? Because you're not in control of your interest payments because they will move because of exchange rate and interest. Now, if things move because of exchange rate, you cannot say the government has increased borrowing. It's just been reflecting exchange rate movements. And there's a lot of that. And some of it also being used as propaganda. But we have actually moved from a primary deficit. Even last year, we were able to move from a primary deficit to a very small primary surplus. And that's the trajectory that you want to keep. And as long, that's really the variable that you want to track, because the others are moving with the market. So the government is not increasing, is not accelerating borrowing.
Any response, Chacha?
I think just to throw it back to Daktari is that probably an area of improvement from the government is just to improve on transparency and also on communication. And where am I coming back? Let me just take you back to, we had the CBK increasing its benchmark rate by 2 percentage points percentage points in December. But that should have been a signaling effect, because actually the intent of that is now to slow, to reduce the FX pass-through to inflation, because that's their mandate, to tackle the price, to increase, to sort of increase price stability. But we saw the currency even continuing its depreciation. And there was one thing that the governor said, that the currency at that point, it was around 155, had already shot its fair value, equilibrium value. So the question still comes back, and that's still hinging on the communication and transparency. What kind of estimated equilibrium or fair value of the shilling that the administration is looking at? I'm coming from a point that, and this is something that, I mean, we can all torture the data and it can confess to anything, however we want it to be. But from where I'm sitting at, I'm looking at also a scenario, if you've seen the shilling having appreciated around 25% from its lows of 164 to where it is right now, the risk that is also there is that if you assume the converse is true, that within a period of 6 weeks, the shilling depreciating this longer, and this is not within a context of a devaluation where we've seen in Egypt and also we've seen in Nigeria where there's those sharp movements. But this kind of moves is quite an outlier. So we really need to hear the government coming and tell us that, okay, this is what is our strategy. And also coming from a perspective, as Dr. has correctly said, the current account deficit has improved over the years. As at the end of last year, looking at something below 4%. So basically, it's not because exports increased, but actually because of import demand being compressed because of the shilling having weakened. So right now, we are at a situation whereby the shilling has improved. So on an expectations, you will expect that people will now ramp up their import demands and sort of now take us back to a widening of our current account deficit. From a fundamental basis, should we now see the shilling now starting to sort of weaken based on that? Or back to the medium-term plan 4? As the government put a strategy to ramp up its exports so that we can see increase in exports so as to be able to improve that the mechanized trade balance, and also FDIs, rather than looking at what foreign publication has done on our Kenyan FDI. Look at the statistics on the ground. At some point, we had the previous years for trade talking about $10 billion in FDI by end of last year. We are punching below our weight. We are at around $500 million on roughly. So it's their efforts to be able to ensure that exports competitiveness has been ramped up so as to be able to ensure a sustainability of the exchange rate. So based on that basis, and looking at the moves you've seen the last 6 weeks, we need to see some better communication so that people can now be able to understand, and even in terms of the outlook, having seen it appreciate this much, will it still stabilize at around 135, 139, between 135 to 139, or should we still expect it to continue appreciating to 100 level? So those are some of the things that is grappling our minds, people's minds. So the administration needs to really come up and clear those things.
Cuba?
Even just based on the explanation we've heard now, which is, a lot of things have been mentioned. I feel like a lot of the uncertainty and tension among Kenyans with regards to what exactly is the government trying to achieve comes from a lack of clarity around essentially what you've just explained, David. So I do believe that the approach of, perhaps these issues are too complex to be explained. I think there can be an adjustment to that, in that a lot can be explained, right, to Kenyans. So for example, if you talk about the G2G deal, a lot of people are just left speculating, right? So I feel like also there is a role of the state in breaking down these issues and making sure that Kenyans do understand what's going on. And I think the attitude of Kenyans cannot understand these complex issues is no longer feasible, right? Because of course that will have the effect of people coming up with their own theories. I still would push the angle of transparency on, for example, debt operations. So even when we consider the kinds of debts that are constructed, is that clear not only to Parliament but also to the public? The terms on which these debts are contracted, the ultimate goal, as has been spoken to, around things like the buyback of the Eurobond, among other things. So I feel like the experience that we've just had has been quite fruitful in terms of the explanation around a lot of those things. But I still do feel like the government can do a lot more to explain to citizens these issues and also engage them on these issues, which is an issue of public participation, right? So when the budget policy statement is put out by the National Treasury and the National Assembly, is there actual indication that the views of Kenyans are being taken on board, right? Among other budget decisions. So I just wanted to emphasize that aspect. That was great.
All right. So, is there any more questions from the audience? John, where is John? From NIBS, lecturer from NIBS. John, where are you? Let's give him a mic.
What's the relationship between taxation and the cost of debt? The relationship between the cost of debt and taxation in Kenya. When answering the same, you could tell us the difference between bills, bonds, debentures, and a normal loan.
David, could you just take that so that we can keep it short though?
Let me first comment on the previous issue about the government being about communication and also about transparency. I think the challenge we have, I used to be in this space of trying to explain economic policy to the public. And I think something has failed there because the caliber of business and economic journalism I see today is very, very poor. It's not the government's fault. But there is also a problem even in the economics I'm hearing from the market analysts I'm sharing with the column because I just said we are not targeting the exchange rate. So the government cannot tell you where the shilling is going to settle by definition. If the exchange rate is not a policy target, then the government cannot give guidance on exchange rate. What you can give guidance on is interest rates, because interest rate is the policy variable. The exchange rate is not a policy variable. And we've moved from that under the table management of the exchange rate of the previous administration. And we've been very transparent about that. And my colleagues here agree that we are restoring the interbank market. And part of the disconnect between the interbank market and what was reported by the central bank is that the central bank was reporting an indicative rate, not the actual rate. Now, we are now reporting the market rate that is transacted on Reuters screens. We are not reporting a number made up by CBK. But beyond that, I think also the understanding of which variables, which are the policy variables that the government, the monetary policy is tracking, so that you can then tell what its policy behavior is likely to be. We have an inflation targeting regime. So the first thing you should look at in terms of monetary policy is inflation. So we jacked up the CBR by 200 basis points. But if you had paid attention to inflation, you will notice that inflation in February fell by 60 basis points. So monetary policy is working. Also, something which has been mentioned, the variable of interest for the government is the current account deficit. And indeed, we wanted that current account deficit to reduce by import compression, because you cannot get a supply response on interest on exports in such a short time. So is policy working? Yes. Is government communicating? Yes. The problem is that people have a wrong theory, economic theory, of what monetary policy is. We are not preoccupied with the exchange rate the way traders are in the market. Government target is inflation and the current account. And those are moving in the right direction. Yeah? So this whole exuberance, excitement of where the shilling is going, what you're dealing with in the short term is volatility. Short-term volatility because of very consequential events in the market. Now that is probably inevitable. When you have that kind of consequential events. Now, so on matters again, in terms of the question about what is the relationship between tax and debt and cost of public debt, actually, ultimately, the variable that will drive your cost of debt, the variable you want ultimately, is inflation. Because what the market is looking for, what a big part of the cost of your debt, if you're talking about market, particularly public debt, is interest rate parity sort of differentials around exchange rate risk. And the fact that people are looking at positive real returns. So the variables you want to pay attention to is your underlying rate of inflation. If you really want to do, you want a strong fiscal regime in terms of budget deficit sustainability. If you have low budget deficits, a stable macroeconomic regime, the macroeconomic risk is what you want to look at. It is not actually taxation. The extent at which taxation is relevant is how robust your tax base is vis-a-vis your debt, because taxation goes into your debt carrying capacity. So the relevant of taxation is if you have a broad and big enough tax base, which is quite robust, then the fiscal risk of your debt is low, so that will probably give you a few notches on your credit ratings, which determines your cost. But more fundamentally, your sort of inflation expectations, how you're managing your macro, the kind of things you're talking about. And ultimately, where the Holy Grail is, what you want to be able to do is actually reduce that wedge between the foreign and domestic interest rates so that investors are indifferent whether they are holding your foreign currency or domestic currency bonds. That's where you want to end up. And that then depends on all those variables put together.
All right, just quickly, those definitions as we wrap up.
Sure. So the definitions around debt, so you can think about debt taking two forms, loan and bond. So in terms of loans, basically everyone knows the concept around loans. You go to a bank, you get a facility, so that's a loan. So you pay principal and interest. But now in the context of a bond, so you have to go within the, rather than a banking system, you go to the capital markets system. So that's where you get investors coming in. So basically an issuer, this is the government of Kenya, floats a bond, basically is offering to the public an opportunity to lend it to the government. So, and then they has this, rather than the interest of a bond is now a coupon. So it's like the government is bonded. So if it floats a 10-year bond, it's like it's bonded to the lender for the next 10 years, committing that it will be giving the coupon rates if it's a 10%. So if you invested $1 million, so the government will be giving you 100,000 for the next 10 years. And then after 10 years, it will be able to return back your 1 million. So basically, that's the difference of a bond, whereby it is in the context of a capital markets vis-a-vis a loan, where you can get from a bank. There are syndicated loans from a syndicate of banks, or even from the multilateral lenders, the IMF and the World Banks that we've been talking about. So in terms of a bid, is pretty much government is floating a bond seeking to raise, say, 70 billion. So it gets interest from the public. So it might come to 100 billion. People now interested in buying this particular bond. So whatever it gets from the public is called the bids. So it can get 100 billion. It can, since it's seeking 70 billion, it can reject 30 billion and just accept 70 billion. So that's pretty much the terminologies, what we've been talking about, loan, bonds, and bids. Yeah.
All right, our final question. This is something that has emerged over the last two debates. And the question is, we do not actually know what Eurobonds have done, except for Eurobond 2 that we know was used to repay the previous Eurobond. And also for the Eurobond floated this year, we also know it was used to pay a previous Eurobond. So is Kenya really ready to borrow? Is Kenya institutionally ready to borrow at conventional rates? This goes to David.
I noted that part of this dichotomy between Eurobond and domestic bonds is a false dichotomy. The only difference is currency. What the government is doing is arbitraging, is diversifying. The reason why I said you have two problems. One is that you need to invest more than you're able to save. So ideally, you can do all that in the domestic market. Okay, and whatever. But also, you need to import more than you export. So you also need a foreign exchange component so that you can be able to finance imports of steel and all the other things and bitumen that you actually need to invest. So what the government is doing is looking at both its budget and its balance of payments and deciding what do you need. If your exports are doing very well, you probably will consider as foreign borrowing because of that external market kind of risk that you would reduce. So all these are really sort of what you might call treasury financing decisions. But when, in particular, you have an open capital account, which you have, and you are integrated in the global market, and you said, even as you are refinancing the Eurobond, foreigners bought $1 billion worth of shilling-denominated infrastructure bond. Yeah, so that's part of the foreign exchange that you're talking about is contributing to the strengthening of the shilling, because market players did not see that coming. Because market players were not paying attention to what's happening in the global market and the US interest rates. All this change began in December when the US Fed gave foreign guidance on the direction of US interest rates. Once you saw a US inflation rate down to below target, US unemployment numbers, a Fed forward guidance, that's what moves markets. So from where we sit, that's what we look at. We are looking at all those things. There's conversations around, which was mentioned, about diversifying in terms of currencies. Those are sort of technical decisions, I mean, in terms of, okay, also aligning, because you have to look at, for example, Chinese currency debt is very interesting and potentially interesting because of a lot of your imports coming out of China. So you are able to then align your currency with your import structure. So those are really technical things. But ultimately what you want is macroeconomic stability, strong macroeconomic stability, monetary policy regime, prudent fiscal regime, so that your sort of underlying and sort of inflation expectations are low, because everything else is stacked up on that.
All right, just quickly, your final remarks, a minute, just quickly, your final remarks as we wrap up. Let's start with you.
Thanks, Mwanzo.org, for organizing this platform, at least to be able to sort of disseminate this pertinent issue around the public debt and Eurobonds. And I think it was great being a panelist with my esteemed colleagues, Cuba and Dr. Ndii. Though we are agreeing to disagree, but at least the divergence of the panelists, I think it's beneficial to the audience, and it will be able to enrich even the public discourse around public debt. So I'm actually honored to be part of a panelist. Thanks.
Cuba. Thank you. I think I echo the comments from Churchill. It's been, I think, an engaging discussion. I've learned quite a bit from the different perspectives that have come about here. As a parting shot, perhaps I would say that I would say that the goal of the state should be to provide services for citizens, right? Particularly the poorest and marginalized, as well as the role that the state plays in regulation and kind of setting up an adequate business environment. But I think the first aspect is something that we really do need to continue to look at, especially as inequalities increase. We have more shocks to our economies that require more robust, for example, social protection systems. So I do also, I think we can agree to disagree. I do agree with a lot of the reasoning that's been brought from both sides, at least theoretically. But yeah, I appreciate the discussion. Thank you.
David.
I would say thank you for inviting me. It's a long time since I was in front of students, so it's a bit nostalgic. So I want to make 2 points. Some of them actually is completing subjects that came up. Do we get value for money for public debt? And the second question is about, in particular, what did we do with to crystallize the issue of which I point about, the infrastructure and that mismatch between debt and returns. Let me start with the second one. The biggest pain point for Kenya today in terms of debt actually is not Eurobond, it's the SGR. Because that's an amortizable loan as opposed to one which you can refinance in the markets, a bank loan, and we are paying $500 million every 6 months. Now, SGR, a railway, is a 50-year, 60-year payback investment. Did it make sense to finance a railway with 15-year money? Probably not. But many people supported it. The public was in support of it. They enjoy riding on the train. I tried to fight against it. Everybody said I was against development, but that was the point I was making. It is not wrong. It's just a mismatch in financing, that there was no way that railway was going to start paying enough money, making enough money to pay its debt, given the structure of the debt. But if you had gone to the market and issued a 50-year bond, and probably had your macros right so that your coupon is quite low, you could probably be able to sort of finance it less painfully. I thought that just illustrates what we mean that it's a financing issue. I have issues of whether we needed the railway in the first place, but many people think it's a good idea. It probably is in the long run, maybe 20 years from now. But in the meantime, it is going to cause a lot of pain. I think that crystallizes the nature of the problem of where we have ended up where we are from the last 10 years. Finally, do we get public value for money? When I was on that side of the table, when I finished university, when I went to university, total university enrollment in a year, I went to university with 2,000 people, other young people. We had 2 public universities, 2.5. 2 existing, one was new enrolled, the first class the year I joined university. We had Nairobi. Kenyatta had just become independent from Nairobi, and Moi University had just been started. Total enrollment of my year cohort, 2,000. Total university enrollment, 7,000 students. Today, 30 public universities plus. I've just been working on the challenge of higher education financing, 30-something public universities, annual enrollment of 100,000 students. So people ask, where does the public money go? Is that value for money or not? Should we be educating our young people? In the last decade, we've increased enrollment in TVETs from 60,000 students to 500,000 students. In fact, this year TVETs have overtaken universities in terms of enrollment. I said we have doubled our roads infrastructure in the last decade. Is that public money for value for money or not? So before we just sing choruses as university students, I just want to invite you to be a little more critical and probably try and be a bit more evidence based in some of these conversations. If you look at just the population growth and what the public delivery of public services to cope with that population growth is, I think you will arrive at a different conclusion.
Thank you so much. That marks the end of our third debate. Today we're discussing, is relying on debt a sustainable economic strategy? Thank you so much to our panelists, starting from the far end, David Ndii, who is the economic advisor to the President of the Republic of Kenya, Cuba Houghton, who is an economic researcher, International Budget Partnership Kenya, and Churchill Ogutu, an economist and as well as asset management expert. My name is Mono Njuguna. Our audience is drawn from KCA University, Zitech University, as well as NIBS and KEMO. That's where we end it for now. Remember, the conversation does not just end here. You can keep the conversation going online. Remember, debt is something that concerns all of us. From me, Mono Njuguna, and the rest of the team, thank you so much for joining us. Keep watching.